that. And for us, that is a pace of rate cuts that's consistent with a recession. So you cut 50 if you think there's a recession, but if you don't think there's a recession, you probably want to cut at a more gradual pace.
Priya Misra of JP Morgan was just on talking about how it's not really her take on what the market is pricing in. She doesn't see the bond market saying there's going to be a recession by pricing in more cuts, but just that the neutral rate is going to be that much lower and that the Fed is going to get there more aggressively now, just simply because you have seen some deterioration in labor markets. Why do you disagree with that?
So what I would say is, yes, it's possible the market is pricing down the neutral rate, but when the Fed is cutting to normalize or it's doing a mid-cycle adjustment, it cuts relatively gradually, right? 25 per meeting, 25 per quarter, something like that, because it doesn't want to convey a sense of panic to markets. Because when you do that, it's almost counterproductive. Then you're no longer supporting financial conditions, right? Because markets think, well, maybe the Fed knows something that we don't know. So 25 basis points if you're normalizing, but when you're cutting 50s, you're not just cutting to get back to neutral. You're probably cutting to get below neutral and actually accommodate the economy.
There's a sense that we've heard from an increasing number of guests that the labor market is actually quickly shifting away from being strong to something much less so. We were hearing just from Austin Goolsbee overnight in a Market Watch interview that actually he sees the data moving more than the Fed officials had expected. What are you saying? What are you seeing in there? The data that seems to reject that points to stability, to strength, to something that really kind of flies in the face of some of these more extreme rate cutting projections.
So we'd point to a couple of things. The first one is the resilience in consumer spending. So if you look at the last 4 or so months, spending has actually accelerated. It's probably running at around a 3% pace, which is above trend. That suggests, one, that the income that's being generated, regardless of what you're seeing in the official data, is sufficient. And two, that solid demand should continue to support decent job growth going forward. The other thing we would point to is we've had a lot of catch-up employment growth in a few sectors: leisure and hospitality, healthcare and private education, and government, right? So those sectors are slowing down. But if you look at the remaining job market, it's kind of just been running flat, right? There isn't clear sign of deterioration. And related to that, layoffs are also still very low. So that gives us hope that the labor market is still just normalizing rather than outright weakening.
Aditya, when you talk about the consumer spending, I think is healthy. What do you make of these CEOs that come out and say, though we do see consumers being choiceful or picky, that they don't still have the same kind of, impulse that we did see a few months ago?
Right, so there's definitely going to be idiosyncratic companies and sectors that are more affected than others, right? In a trend-like economy, a good chunk of the economy is running below trend. And that's going to affect certain companies. But if you look at the aggregate data, which I think is the best that we can do, then things looked a little soft at the start of the year. But May, June, July were pretty good months, right? So overall, all we can say is spending's holding up. There's also this possibility that, what you see in the stock market is not necessarily representative of overall consumer spending. A lot of consumer spending happens in service sectors that aren't well represented in stocks.
Aditya, before you go, I just wanted to get your thoughts on Governor Waller, who speaks ahead of the quiet period. The Fed speaks so far, we've touched on that. What are you looking for from the Fed officials going into the quiet period?
So we really like listening to Governor Waller. We think he's probably the second most important voice on the Fed. And part of that is because he's very forthcoming in answering questions, right? And he's very direct with telling you what his view is. So we would expect, if the markets are somewhere between 25 and 50, we would expect clear guidance from Waller. I think if you're close to 25 or 50, you've probably gotten a strong enough signal from the jobs report that you don't need Waller to take a strong stance. I mean, there is some tail risk that he'll have to jawbone the markets, but I don't think that's necessarily the most likely outcome.
It's an event to watch, that's for sure. Aditya, one of the best, one of the very best. Thank you for being with us, sir. Aditya Bava there of Bank of America Global Research, looking for 200K on payrolls in 35 minutes. Talking
about payback from the last report and then also just this ongoing resilience. One thing we haven't talked about, revisions to the prior month, revisions to the prior several months. What happens if they come in significant and actually downwardly revise some of those data points, these have been messy numbers, and they've been moving quite a bit.
You know, the other revisions we haven't talked much about, the summary of economic projections gets an update September 18th. They've got unemployment year-end at 4%. Year-end 2025, they've got it at 4.2. Year-end 2026, they've got it at 4.1. Aren't we due a revision on that front as well?
Especially at a time where we're hearing from Fed officials that the data is moving a little bit more quickly than they previously expected. And oh yeah, guess what? We're already well through the unemployment rate.
Get a brand new dot plot as well, so lots to get excited about on September 18th.
Keep it down. Keep it down, John.
The next hour looks like this. Nadia Lovell of UBS, Michael Collins of Peach and Fixed Income, Jeff Rosenberg of BlackRock, and Torsten Slock of Apollo. Am I getting too excited?
Well, can I just say that I know people who make dot plot cupcakes.
Do they?
Pass them out. Yeah, I remember that in the Bloomberg newsroom.
Someone did that at the newsroom?
Someone did dot plot cupcakes.
That's quite sad.
Yeah, I didn't really understand.
Do you want to name and shame now, or you want to tell me the commercial break?
We'll discuss in the commercial.
Okay. And then everyone gets to guess. From New York, this is Bloomberg.
You are also an owner, I should have pointed out, of 3 major sports teams.
That's right.
Right? And you're the first woman, as I understand it, first woman to own 3 major, have a stake in 3 major sports teams. Is that right?
Yes, and we'll say African American.
You were approached by the owner then of the, I guess, the Washington Wizards and the Washington Caps about maybe buying the Washington Mystics, which is the women's basketball team. And what did you say?
Well, first of all, it was Abe Pollin. He did come to me and Susan O'Malley, and they said, Abe Pollin says, look, I want you to be the face of the Washington Mystics. And I said, what do you mean be the face of? He says, I want you to buy this team. His health was failing. And I have to tell you, and a lot of women can understand this, we never get these opportunities. So that was the first thing that struck me, and I was flattered. I was really flattered. I said, well, Abe, what are the financials on this? And he handed them to me. He says, well, they're not making money. But I was still intrigued about team ownership.
Morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia. We'll walk you through what you need to know to kickstart the European trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything.
AI, how it has penetrated pretty much all sectors, including music. AI can write music, compose music. How do you see AI changing the landscape in fashion?
Yeah, AI definitely helped. When I did the jewelry, I used the AI, helping me to give some idea, but ultimately you still have to do a lot with it. They just give you very superficial ideas, and but at the end you still have to customize and have to really make it and do that. I do not think that AI and the technology can replace the human mind at this moment.
Are you concerned one day we won't be able to differentiate designs by AI and designs by an actual designer?
I don't know. For me, I feel that when a designer is doing is the spirit, is the heart that the computer don't have.
Power, money, culture. As Linda Aman tells the story of Asia's rise through the people who are helping to shape it. The Serum Institute was a major player in the fight against COVID-19.
We're in a race to procure raw material that was sanctioned.
And now CEO Adar Poonawalla is bracing India for the next pandemic.
I'm not losing sleep over which day and when it's going to come out, but we're definitely prepared.
Latitude, encore presentation this weekend, only on Bloomberg.
The the unemployment rate moves up again, if you get a significant rise there, I think that's going to be a pretty worrying signal.
We're looking for north of 200K. Very importantly, a decline in the unemployment rate.
If we see a number closer to 100,000 this month, then we'll have to reassess our sort of view on the labor market.
It would take, we think, a pretty significant downside surprise to drive markets much lower.
There's no magic number here. It really is about the direction. And we should expect to see more softening in the labor market.
This is Bloomberg Surveillance with Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern.
So this is it. This is the hour. The jobs report 30 minutes away. The estimates look like this: 165K, the median estimate in our survey for the headline payrolls print. For unemployment, looking for that to drop back from 4.3 to 4.2%. The jobs report just around the corner. The opening bell 90 minutes away, and the scores look like this in the equity market. A three-day slide looks like it could become 4. We're down by 0.5% on the S&P 500. On the NASDAQ, down by 0.9. In the bond market, a 20 basis point move on a 2-year and a 10-year so far this week. The rally in fixed income, Lisa, continues.
And really, to me, this is the most pivotal jobs report of the year. And we don't always say that, but to me, this really marks the difference in terms of the tone, the tenor, and the speed of the Fed's rate-cutting cycle. People have said this. They've doubled down on it at a time where the time has come to start cutting. Now the question is to where and how quickly.
It won't determine whether they cut, but by how much.
Correct.
That's been the feeling for a while. What we need to gauge over the next 30 minutes, though, just get a clearer idea of how low that number needs to be to really cement this idea they go 50.
Well, what people are talking about is, what is the unemployment rate? How much does it come down or does it go up? Because that's also going to determine some of these other factors, like how big is the labor market? What is a good number? Things that we don't have a clear sense on. And then we aren't really talking about this, but we should. Downward or upward revisions to prior months of data, because we have seen a lot of messiness there. And if they upgrade last month's data to become better than it was, well, then we don't have the same kind of trend. But if they downgrade it, just watch. All of a sudden, you could get very different language from Chris Waller and a very different response from markets.
On the heels of that 800,000 downgrade we recently had, it feels like we have this spectrum of, we just heard from Aditya, 200,000 on the payrolls increase. That's 25. Andrew Hollenhorst, we heard from this morning and just published, he expects below consensus 125 new jobs, unemployment holding at 4.3 to be enough to go 50. It's that range on whether or not potentially it may push the Fed.
And it's not a big range. Let's be clear about that. Was the 4.3% unemployment, the 114 on jobs, signal or noise? Can you really point to factories in Michigan retooling, to weather issues down in Texas, as a reason to expect big payback in 27 minutes? The people looking for the 200K type numbers, that's what they're expecting.
To me, it seems like the question is also what the read-through is for the longer-term trajectory. The 200,000 crew believe in the soft landing. They believe that weakness that we've seen in the market is not something that is going to be more protracted and deeper and nonlinear. The people who see 125, the Andrew Hollenhorsts of the world, 125,000 and a greater chance of recession are those who see a quickly moving market to a different lower shift. And to me, that is the reason why suddenly you have Citigroup talking about this Fed not taking baby steps on the way up. Why should they take baby steps on the way down, especially if you see deterioration that continues to rear its head?
8:30 Eastern Time, 26 minutes away. Equities right now just off session lows on the S&P 500, still down by 0.5%. In the bond market, yields lower by 2 or 3 basis points, 369.86. The currency pair to watch, dollar yen. 4-day slide, 4 days of yen strength. How much more yen strength can we generate off this story in the U.S.?
Well, not just the U.S., also the other side. Actually, quite a bit. And here's the issue, and you've raised this before. Have we really blown out all the longs? Are we really done with that trade? Or could that be another disruption akin to what we saw August 2nd when we got the other labor market report at a time when we still saw a pretty big leveraged trade position?
Late start to the weekend for those of you in Japan. Good evening, Tokyo. Said this so many times, haven't we, over the last few months. Coming up on this program, Nadia Lovell of UBS on why markets can continue to grind higher. Mike Collins of PGIM Fixed Income as traders see a growing chance of a jumbo September cut. And Torsten Slock of Apollo reacting to the jobs data. We begin with our top story. August payrolls out in just under 30 minutes' time. Data expected to determine the size of the Fed's next move. Nadia Lovell of UBS saying the soft landing remains on track. The labour market will cool gradually rather than contract. We continue to expect the Fed to start rate cutting in September. Base case, 100 basis points in 2024. Nadia's with us for more. Nadia, good morning to you.
Morning.
Last time we were with you, it was right before that payrolls print on August 2nd, 30 minutes before, and you were talking about the prospect of a soft landing. Has anything changed in your view with the data we've had in between those conversations?
I think largely, no, we wouldn't say anything has changed. We are still in that soft landing cap. There isn't any indication to us that the economy is decelerating at an accelerated pace. Of course, we're all watching payrolls, just given the weakness in July. But so far, weekly jobless claims has been well behaved. And what we're hearing from corporations, we're not really hearing any sort of broad-based slowdown. I mean, I know there was a consumer conference this week, and obviously you were at some. What I'm hearing from our consumer analysts is that the tone has been fairly constructive and seeing some positive data points coming out of consumer in August.
So if you expect growth to hold up and rates still to come down, why are you all in on small caps, all in on discretionary?
So a view on small cap has more to do with the sustainability of any sort of earnings growth in small cap. A lot has to go right, come together for the small cap trade to work. And quite frankly, some of it has already run ahead of itself. Small cap also needs the manufacturing part of the economy to cooperate. We haven't been seeing that in terms of the ISM manufacturing has continued to be weak. This is why we continue to lead into large cap because of a secular growth. Now, while I say that the economy isn't coming to a screeching halt, it is slowing down. 2% growth is still good, but small cap also needs that Fed to be a little bit more aggressive in terms of reducing rates for it to work.
I can just feel in the back of my head all the people calling you up. Do I just buy all the NVIDIA that I possibly can get? Is that essentially what you're saying?
Absolutely not. I mean, we have taken a more balanced approach in our sector position, and just given reality is, yes, there are parts of the economy that are still weak and feeling the pressure of restrictive monetary policy. So we do think that it is important to anchor in secular growth in tech, add some cyclical in financials, and then also a bit of a defensive exposure in utility. So right now we're in this phase where you want to be a little bit more balanced because, yes, the data is a little bit murky.
I want to just go back to this idea where you expect the Federal Reserve to cut by 100 basis points this year, and yet you still see a soft landing. You still see the S&P 500 ending the year at 5,900, again, from where we are now. Can you square those two ideas, that the Fed could cut pretty aggressively, and yet that doesn't necessarily mean that they see real trouble?
Yes. So in terms of the 100 basis point cut that our economist has penciled in, we're all data dependent. A lot is going to depend on payroll. Where we sit today, we'll know in a few minutes, it does feel like it's probably more of a 25 basis points cut to start off in September. But we want to maintain that optionality because we know that the data can shift quickly. So that 100 basis points cut could be more 75 basis points cut. Now, in terms of what you're seeing from the corporate side, you are seeing corporations holding in. Q2 earnings beat expectations. You're not seeing much downward revision to the forward estimates. So that's why we think that this market can continue to rally. Now, that's not to say there won't be near-term volatility. Right now, investors are on edge. And so far, it's been a good year. So you could see some people continue to take profits. You need that clarity. So we think the next couple of months will be volatile. But once we get into third quarter earnings as well as into Q4, we think that this market will start to regain its footing.
Once you want to buy ahead of that, what do you like right now?
Right now, tech, we continue to like tech, as I noted earlier, but we do expect some volatility in tech. And so we have been encouraging investors and clients to get that shopping list ready. And what's on that shopping list is going to be quality. We would be leaning into those AI logic chip names and also some of the foundry names. We think that the AI story is still largely intact. CapEx continues to move higher. And I know that there are questions, of course, around return on investment capital, but you are seeing use cases come through. Speaking of NVIDIA, we did hear NVIDIA say 40% of its data center revenues over the last 12 months came from inferencing. That's actually tied to model usage and actually tied to return on investment capital. Walmart also talked about, using AI and, for their projects. And if they didn't, that would be 100 times more headcount that they would have needed. It will take time, but we're seeing evidence of it.
I guess one of the uncertainties, and we've seen people struggle with this all year, is just how much rate cuts are going to support further gains in equities. And you're saying that there is a possibility that it could be 75 basis points of rate cuts, but there's also a possibility of 150 basis points of rate cuts. Would that be bad for stocks?
Yes, we do think so near term. Now, because it would suggest that something is breaking or has broken and the Fed needs to accelerate. We want the rate cuts to be gradual. We want it to be a marathon, not a sprint. If we're in a sprint, the equity market will react to that because now it's concerns about what does that mean for corporate earnings and what does that mean for growth going forward. So I think, if you get between 75 and 100, that's probably more palatable to equities than if you get 150 basis points.
We know what you like. One of your least preferred sectors is real estate, but we have rate cuts happening basically around the block. On top of the fact that Washington, bipartisanship, we're seeing, talking about the housing market. What would it take for you to maybe like real estate?
I think what we need to see is that the estimates come down a bit more. Real estate has started to perform better, yes, and I think it is run ahead of itself in terms of anticipation of rate cuts. There are still some capacity issues within real estate that we think that will start to filter through the earnings. So we think that there's a bit more downside to earnings and, FFFO. In terms of the other areas that we also are a bit cautious on, materials. We know that that's very much tied to China, and the data is just not coming in. It's coming in weak. And then also, we're not seeing any sort of real pickup in industrial gas volume. So those are the two areas that we're a little bit more cautious on.
The commodity market's been difficult, that's for sure. Nadia, thank you. It's good to see you. Nadia Lover there of UBS going into the jobs report 20 minutes away. The estimate 165K. Neil Dutta of Renmac writes in. Here's a line from him. Whatever the number is, it's being overestimated. We've asked this question so many times over the last week. Should we just chop off 60 or 70K from whatever this number is at 8:30?
I mean, let's say it's 145. Does that mean it's 85? I mean, how much? And that's why we go to the downward revisions. How much will that matter? Almost just as much of prior months as the actual headline number that we get today.
Chairman Powell back in July poured cold water over some of these numbers as well, remember? That was before August, before the number. He was talking about some of these figures being overestimated. 165 revised down to what, 80? Is that what we're running with, 90?
Well, revised down 60,000. That was sort of the average. I will just say this. He knows something that we don't know.
Who, Chairman Powell?
Yeah.
What do you think of that, the signalling from this? That if they go 50, it's something to worry about. What do you make of that conversation?
It's so fascinating to me because I've heard both. I've heard that on one hand, if the Fed is aggressively or incredibly tight, restrictive, why shouldn't they go quickly? Why shouldn't they get down to a level that's more closer to neutral, just simply to adjust to where the economy is going? And then you have Drew Mattis writing in, going aggressively on the way up didn't turn out so well, so maybe baby steps or a sense of humility would be warranted. So you have both kind of coming out. Really, to me, one of the most interesting questions is, if they cut 50 basis points, is that negative for stocks?
I like the Conisend thought exercise. Blank sheet of paper. If you came in from Mars and you asked yourself, what's the right interest rate for this economy, given where inflation is, given what the trend in jobs is, would you come up with 5.5%? Would you? I'm not so sure you would.
And if you came up with the more likely 4%, would you be okay with just saying, okay, well, why not just reset it there right now?
Jobs right now, we're looking for 165, the unemployment rate, looking for that to decline to 4.2% from 4.3. We'll settle all of this, maybe, at 8:30 Eastern Time. Let's give you an update on stories elsewhere. Here's your Bloomberg Brief with Danny Berger. Hey, Danny.
Hey, John. Former Bank of Japan Governor Haruhiko Kuroda signaled that the BOJ has a lot more room to raise rates. He said that the nominal neutral rate could be less than 2%. After their most recent hike, the key rate sits at just 0.25%. Kuroda joins other ex-officials who've told Bloomberg that rate hikes could be faster than most expect. Dollar yen sits around 143. That is a lower level than the early August aftermath of the BOJ hike and July jobs report. ABC reporting that President Biden is set to sign an executive order today for federal grants that prioritize projects with organized labor. Biden will make the announcement at a union trading center in Ann Arbor, Michigan. The party and VP Harris's campaign have been trying to shore up union support. Along with labor agreements, the grants would prioritize projects with wage standards and benefits like access to childcare and apprentice programs. Bloomberg has learned that Intel is weighing a sale of a part of its majority stake in Mobileye. It's part of a major strategy overhaul to improve performance. Sources say Intel could offload some 88% of its holding in Mobileye on the public market or via a sale to a third party. Mobileye has a board meeting later this month in New York where Intel's plans will reportedly be considered. And that's your brief, John.
Danny, thank you. Back with Danny in about 30 minutes' time. Up next on the program, we'll get you some morning calls, plus looking ahead to the payrolls report with Mike Collins of PGIM Fixed Income. That payrolls report 15 minutes away.
heartbeat of the tech sector.
Spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
Top names at Jackson Hole are on Bloomberg.
So we know that unemployment rates have gone from about 3.4% to 4.3%. That's a big change. Now, it's from super hot to solid, right? So I don't want to make it seem like labor markets are weak. But it really starts to tell me that things are much more imbalanced than they have been for quite some time.
Nobody covers Jackson Hole like Bloomberg. Context changes everything.
DOJ or other authorities.
Could face bigger challenges next.
It was going to keep reading
World Cup. This is a three.
As the economic picture.
Covering the intersections of Hollywood, Silicon Valley, and beyond.
The jobs report, 8:30 Eastern Time. We're looking for 165K. That's the estimate in our survey here at Bloomberg. The unemployment rate, 4.2%. That's the estimate against last month's 4.3. Equities negative by 0.5% on the S&P 500. In the bond market, the rally continues. Yields lower by 2 basis points. The 10-year 370.42. Let's get you some morning calls. First up, UBS lowering its Broadcom price target to 170 and keeping a buy rating. The analyst saying overall revenue guidance fell short of expectations. That stock lower by more than 7% in the pre-market. Your second call from JP Morgan downgrading Supermicro to neutral. The analyst citing a delayed 10K filing after the company said it needed more time to assess its internal controls. This has been building now for the best part of a week. We're down by 2% in early trading. And finally, KeyBank lowering its price target on Verizon to 44 and keeping an overweight rating following the announcement of the Frontier Communications acquisition. That stock is positive by, let's call it, 0.25%. Elsewhere, the focus firmly on the August payrolls report just a few moments away. Bloomberg survey looking for 165K and unemployment to drop to 4.2%. Michael Collins of PGIM joins us now for more. Mike, always special to catch up with you on Payrolls Friday, sir. Welcome back to the program and good morning. The focus for you and the team, what are you focused on at 8:30?
Yeah, obviously, this could be a real market-moving jobs number, Jonathan. I think if it prints based on those expectations you just showed on the screen, I would bet short rates actually back up a little bit. There's a lot of rate cuts priced in. In fact, right now, as of this morning, the funds rate that's priced in just 1 year from now is all the way down to 3%, right? So that's 230 plus basis points of rate cuts in 12 months. It almost feels like you need something more than what we're seeing, which is just a kind of a gradual slowdown in the economy, a gradual weakening of the labor market. But to get those kind of rate cuts, it feels like you need something worse than that. So, you know, a bigger number, obviously, the front end could back up a lot if you get a surprise on the upside because of all of these cuts priced in. If the number, you know, prints below 100, I mean, I guess the front end rallies. I guess you can continue to see the curve bull steepening. But man, there's a lot of cuts already priced in, so it feels pretty full to us.
There's just a feeling though, Mike, whatever the number is, this bond market gets bought either way. There's just a feeling that that's the bias right now in fixed income. Do you sense the same thing?
You know, that has been the bias, Jonathan, and rightfully so. I mean, the economy feels like it's weakening pretty quickly here. It's been kind of on a moderating slowdown, and it feels like maybe we're starting to hit this inflection point where demand is coming off harder. We had some big international trucking companies report really weak numbers this week, and that's really typically a good leading indicator for economic activity generally. The manufacturing sector broadly, Jonathan, feels like it's in a recession. So the jobs number, the labor market is usually the last thing to fall, right? We looked at data this morning historically. The recession happens when the job number turns negative, right? So the jobs number is not a leading indicator. It is a coincident or even slightly lagging indicator. So given all of that, and obviously inflation, we're not even talking about anymore, right? It feels like it's dead in its tracks and stuck at 2% here, maybe indefinitely, maybe even going lower. So the bond market has been rallying because of all of this data. But again, there's a lot of cuts. There are a lot of cuts priced in. If you get an upside surprise, you could get a big sell-off in the front end.
Mike, it's funny because you're making the argument for why all of these cuts actually make sense and why you should lean into it. It sort of goes to this feeling that maybe we're going back to the environment that we left, of basically the neutral rate being substantially below where we are currently, and why not get the Fed to move more quickly to get closer to that, just to avoid that kind of falling off a cliff moment. What's the argument against that, Mike? I mean, what kind of number would you have to see to get behind some of the cuts that you're seeing priced in and then some?
Yeah, I think if you see, like I said, if you see the number come in as expected, I wouldn't be surprised to see some of those rate cuts come out of the market. Right now, there's over 100 basis points of cuts priced in for this year. So more than just one 50 basis point cut. There's almost a 50% chance of a 50 in the September meeting. So again, pretty aggressive cuts. But that being said, Lisa, I mean, you're right. I mean, like I said when I was on your program last time, I think the funds rate should today probably be closer to 3.5% than 5.5%, right? So if the Fed could snap their fingers and get it down to 3.5%, they would probably love to do that, but obviously financial conditions would ease significantly. So they have to be careful. They're really cognizant of financial conditions. I'm looking at yields on the corporate bond market today. I mean, they were at 6.5% not that long ago. They're at, about 4 3/4 today. The high yield market was in the 9s. It's at, just over 7%. I mean, we're getting back to much more historically normal levels, and companies, as you've seen, are issuing like mad. You're seeing a pickup in M&A activity. So definitely, animal spirits are alive and well, and the Fed has to be careful about that.
So are you basically saying, if I'm extrapolating out perhaps a little bit too much, that you think if the Fed goes as aggressively as the market is pricing in, that you run the risk of reigniting inflation as a serious concern, and that actually overheating becomes once again in the forefront of our minds, even now with some of this economic data and those trucking companies reporting some disappointing earnings?
Yeah, it is difficult to see the economy kind of resurge, go higher again, right? To overheat, Lisa, and it's difficult for us to really see inflation start going back up again. But obviously, the Fed is really worried about that. I mean, there's a lot of reasons why inflation could be stickier, right? And you have all this geopolitical risk that seems to be getting worse, not better. And obviously, the political situation could spur more economic activity and cause inflation to go higher, given tariffs, et cetera. There are labor shortages around the world. You have, energy problems, this energy transition and climate risk. So there's a lot of reasons to think that inflation could be stickier. And the Fed is really focused on that, right? I mean, personally, it feels like inflation is moving in one direction and it's toward two. So, there's the markets feel pretty balanced here. I mean, the 10-year Treasury, where it is today, feels fair value to maybe a little bit full, like I said. We would really look for opportunities to add duration if rates back up from here. But the trend, as you said, has been one way so far.
Mike, I'm distracted. I've been down to ask for the last 5 minutes. Who gets the trophy? What's it for?
Hopefully me, Jonathan. This is our annual golf tournament, so I'm in third place. Looking to take it home.
Good luck. Michael Collins, Featuring Fixed Income. Thank you, sir. The real stuff. You find out what they're really up to going into the weekend. It's like payrolls, yes, super serious. Golf tournament. Final round.
So how quickly does the tie come off? Sort of pull on.
The golf shoes are on and they're ready to go.
Yeah, exactly.
Like 8:31 Eastern time.
You're down.
At the door. Mike McKee's ready to go. He's in the studio. Mike, it's good to see you, sir.
Yeah.
Do you think Wall Street's overdoing it here?
Yes and no. I mean, it matters a lot for Wall Street because you're betting on, you're making asset bets on what you think is going to happen. But I think that I've pointed out to you earlier that the Fed isn't saying that they're data point dependent and this will make all their decision for them. And we were talking in the green room a little earlier about how this is going to matter for a few days, but then all of a sudden we're going to start talking about the SEP. What is their forecast for the future? And that's what will matter going into the Fed meeting. So it all kind of just goes by. I also pointed out that more Americans are worried about what Taylor Swift wore last night to the Chiefs game than the jobs report, I'll bet you.
Surveillance is very concerned, though, about the jobs report, and let's focus on that. And I would like to say that we're very focused on the statement of economic projections and how this labor market report fits into that. And that, I think, is the reason why it really matters.
And that jobs report drops next, 5 minutes away. Going into it, equity futures decline on the S&P 500, just a little bit softer, and the bid in bonds begins to fade. Yields are lower by not even a basis point at the front end of the curve. The jobs report up next. Mike McKee breaks it down, reacting. Jeff Rosenberg of BlackRock, Torsten Slock of Apollo from New York. This is Bloomberg.
It's the world's second largest economy with a growing influence in global affairs. But geopolitical uncertainties, deflationary pressures, and questions about foreign investment linger. Bloomberg, the China Show, brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China. Bloomberg, the China Show. Weekdays at 9 a.m. Hong Kong time, right here on Bloomberg. Context changes everything.
As we spend some time here on the broader presidential race.
Let's focus in on European politics.
Makes you wonder how politics might play out.
Get your fixed income fix. Watch Bloomberg Real Yield every Friday right here on Bloomberg. Context changes everything.
Today's CFOs are reshaping the C-suite. Bloomberg's chief future officer shines a spotlight on these dynamic leaders.
Healthcare giant Johnson & Johnson is staking its future on innovation. Making investment decisions under pressure has become business as usual for CFO Joe Wolk.
The world is coming at us faster than it ever has. We're getting information more quickly. We're going to have to move faster. The competition's moving faster.
Watch Chief Future Officer Wednesday, only on Bloomberg.
The jobs report, 25 seconds away. The scores look like this. Equity futures on the S&P 500 declining by 0.5%. On the NASDAQ 100 down by 0.8 in the bond market. Let's take a look at the yield curve. 2-year, 10-year, 30-year. Yields just a little bit lower, down a basis point on a 2-year. 372. On a 10-year, down 3, 369.67. The number we're looking for, 165 with the jobs number. Here's Mike McKee.
Well, here we go. Somewhere in between. That's going to make a dilemma for Wall Street. 142,000 jobs, but the unemployment rate does tick back down to 4.2%. Net revisions over the past 2 months down 86,000. So you take 86,000 away. Now we'll have to see what the breakdown of that is, because if you took 86,000 away from last month's very low number, you're not going to get very much. Average hourly earnings up 0.4, much stronger than the 0.2 of the month before of July, even higher than the 0.3 anticipated. And weekly hours rise to 34.3. Now, if you were looking for some sign that the economy was slowing, but we're not yet laying off people, you'd look for jobs to be, for hours to be cut back, and that is not what is happening at the moment. So I'll break down more of this, and John, you'll tell us what the markets think.
I was hoping you'd carry on for a little while so I could make sense of it, Mike. So initially off the back of this, the bond market got sold, and then it immediately got bought. At the front end of the yield curve, we're down by 8 basis points on a 2-year. As we always say, it's the first move. This is the second move. We'll see if it sticks. On a 10-year, we're down about 5 basis points. It's a break of 370. So that's the bond market picture. In response to that, in foreign exchange, dollar-yen dropping lower to about 142, so we're negative by 0.6%. Near session lows on that currency pair. The equity market turned positive initially at first look, and then dropped back again. On the S&P 500, we're down by 0.5. On the NASDAQ, we're about back to where we were, down by 0.9. At first look at these numbers, Lisa, I have to say, these numbers will not solve the debate in any way, shape or form on Wall Street this morning.
Definitely won't solve the debate, but one aspect of these definitely speaks the loudest to me, and that's, and I'm biased, obviously, because this is what I thought going in, the downward revisions, and the fact that last month, which was already negative, was revised lower even to 89,000. To me, that is significant, and that is going to cause the Federal Reserve to have a more difficult decision than, say, if it were 100,000, but still you are seeing that being priced into markets. This is a Fed that's going to be headed lower on a more aggressive path.
So the bad news is last month was even worse than we thought it was. Mike McKee, the good news is that unemployment's dropped back from 4.3 to 4.2. Is this good or bad?
Yes. It depends on what you're looking at. I think this doesn't make a case one way or another, which would leave you with a default of 25 basis points. Now, job growth is slower. We've got to break that down and figure out exactly what's going on with that. But the unemployment rate falling back tells the Fed that we're not losing a lot of workers and the economy is not falling off a cliff.
What this does show me, though, is that these are messy numbers and that the path has been downward, and that has been the consistent path in terms of revisions. Mike, are revisions getting maybe a bigger look in this particular cycle just because it has been a noisier set of data post-pandemic?
Well, I suppose they're getting a bigger look, but you always get revisions, and they follow the trend. When the economy is slowing, revisions tend to be negative. When the economy is growing, they tend to be positive, and we're obviously in a slowing environment, so the revisions are going to be negative. That's not going to surprise anybody at the Federal Reserve, but basically, what they're looking at is how many people have lost their jobs and why. And that's the question that we've been trying to answer now. Remember last month we saw a huge number of people who had lost temporary jobs or were on temporary layoff, and that number has dropped back tremendously. It was 1,062,000 in July, and now it's 872,000. So we're looking at a change of 190,000 lower, and that does suggest that the July numbers in terms of unemployment were a kind of a one-off.
In the commercial break, we were debating with Jeff Rosenberg of BlackRock what would be the most confusing labour market report today for the Federal Reserve and for market participants, and Jeff said something like, if you got a slightly softer jobs report, but unemployment actually dropped back from 4.3 to, say, 4.2, and Jeff, we got a mix. That's the mix we've got. So Jeff Rosenberg of BlackRock. Jeff, please make sense of this for us.
Yeah, tough to make sense of it. It's a bit of that mixture, but I think the headline reaction is to the slightly weaker payroll headline and the revisions, as Lisa was pointing out. So it's a little bit weaker on margin. You know, the bond market is very much behaving as if, you know, if we price it, they will cut. And so increasing the probability or trying to push the probability to 50. I don't think this report is definitive on the 25 versus 50. I think it's going to be Waller.
What do you want from Governor Waller? Jeff, at 11 a.m. Eastern Time. What are you looking for? You think that's the final voice that sets up whether we go 25 or 50?
I think it is. I mean, I think it's set up on the calendar to give markets clarity on what the Fed's going to do. He will have had the information. He would have had a chance to talk to Powell. And so that you don't get a big market reaction, not next Wednesday, but the 18th when the FOMC meets. So I think it is intended to, provide a little bit of a steer to the market. So I think that's going to be, as important as the number that just dropped, what we get in terms of the reaction. And it's hard to say, which way they go. I think the market is pushing for 50. This number isn't, particularly weak. You have the potential of the first print bias lower on the headline. Maybe that gets revised, up. We're talking about revisions. This is a weirdness in the data where August tends to be weaker. There's a slowing, and there's an argument, on both sides. If they do 50, does that, kind of signal too much concern? They can talk around that. They can talk about 50 and talk about their confidence in the economy and kind of ease some of that concern. So the market has been kind of right in the middle between the two. This morning, I think it's really just about that revisions and a little bit weaker relative to the expectations and consensus around 165, coming in a little bit below that.
As an investor, what's your response mechanism to a Fed that signals 50 basis points of a rate cut? Is it basically just extrapolating out about 150 basis points of cuts this year, and that essentially that's going to be questionable for risk assets? Or do you say this is supportive because this means that they're going to adjust quickly back to something that the market thinks is more neutral?
Yeah, we had that debate yesterday. I think it's a tough one. Typically when the Fed cuts 50, they're cutting 50 because there's a growing deceleration in the economic data. This is a tricky period because you obviously have a lot of focus on the labor markets and the labor market deceleration as being the leading indicator. It's not really a leading indicator. It's kind of coincident. Some measures are lagging. The rest of the economy looks strong, but there's this fear that the Fed is behind the curve and that the rest of the slowdown is coming, and the rise in terms of kind of hard landing fears. And so 50 might, kind of push people along that direction. So it's more negative rather than the Fed's kind of on the job. It's, the Fed's behind the curve. The 50 basis points validates our fear. And then you have all the other issues in terms of, risks, high valuations, concentration in terms of valuation in the tech sector, all kind of leading to a lot of angst. And then even what we saw last month, in terms of the outsized market reaction, positioning I'm talking about August 2nd and August 5th. So I think the risk here is that 50 could be more of a negative signal than a reassuring signal that the Fed's on the case. But yeah, it's a tough call either way.
Well, you were having the debate yesterday, Jeff, not just the market more broadly. What would your reaction be given the fact that the Fed doesn't have proprietary data that we don't see that points to a more conclusive signal about where this economy is headed?
Yeah, it's really about the Fed's shift. We saw it from Jackson Hole and Powell, and it's shifted this whole narrative focus and really market reaction focus onto the growth data away from the inflation data. And that shift means the Fed is worried now more about securing the benefits of their past policy intervention to secure the benefits of reducing inflation, and now focusing on securing the soft landing. So any signals around their sensitivity, any validation of that in terms of the data, makes people very much on edge that you're, back not to the what Powell called the era of flouted rules, that, you can't rely on these rules like the SOM rule, like labor market differentials and other things that people point to when you have recession signals, that those may actually in this time, be the right signal. And that kind of concern that you see in many commentary, many forecasts, gets more validated under a 50 basis point cut scenario. And I think that's the concern. That would be, the pushback. They can signal around that. They can use the language. They can use the press conference to manage that. But It's a tricky needle to thread.
Hey, Jeff, this was great. Jeff Rosenberg of BlackRock. They can use the speeches through the next few hours. 8:45 Eastern Time, we'll hear from the New York Fed President John Williams. Later on this morning, Governor Waller at 11 a.m. There was a note from Neil Dutter of Renmac before this number dropped. He said, whatever the number is, it's being overestimated. When we talk about the bias in the market, you nailed it, Bramo. You talked about the revisions. That's what Neil's talking about.
This idea that probably you could see even more downward revisions, and something that Mike said, when you have a slowing economy or a slowing labor market, the revisions tend to be to the downside. If that's the case, doesn't this just edify that kind of sense that we're slowing? It sounded like Jeff Rosenberg didn't have a conclusion to the debate in terms of how they're going to respond.
There's no conclusion to this debate.
There is no conclusion, and that's, I think, the issue. People don't know how to deal with this, but you are seeing that sort of jitteriness follow through after this with yields markedly lower.
I can tell you what the bond market is doing, just to pick up on Lisa's comment, with yields lower. We're down 9 basis points at the front end. Just moments ago, we took out the August 5th low on the 2-year, which was the low for the year. We dropped to about 363. We're at 364 right now at the front end of the curve. So that's a double-digit basis point move on 2s. On the 10-year, we're down 5 basis points at 367. Equities are curious because once you see that picture, you start to think about the bad news is bad news scenario. Equities are doing okay for now. Equity futures, Lisa, down by 0.2%.
Which is essentially what a lot of people are hoping the Fed can actually navigate, which is a 50 basis point rate cut, which is now being basically priced in this month with that positive view forward that they're just adjusting rates more quickly to a neutral rate, not responding to an emergency situation.
Mike McKee still with us, going through these numbers. Mike, what jumps out for you?
Well, I'm going to front run John Williams and Chris Waller and say that they're going to do 25 based on the underlying numbers here, which are all pretty good from the Fed's point of view. Aggregate weekly hours up 0.3 after falling the prior month. That's used as a sort of proxy to help you figure out GDP. When you look at the unemployment rate, the level change in the labor force was up only 120,000. It was up 420,000 the month before. The number of unemployed went down by 48,000 in the household survey, while the number of employed went up 168,000. And we already mentioned hours worked. They went up. Not only did hours worked go up in general, but manufacturing hours worked went up and overtime hours worked went up. So it does appear that the economy is still fairly strong. And this sort of matches what we saw in the Beige Book. Companies aren't getting rid of workers, but they're not hiring them either. So if you're the Fed, there doesn't seem to be an emergency.
Torsten Slock of Apollo got 2 benefits there. One, he got an extra 12 minutes to go over all of this, and 2, Mike McKee set him up perfectly because, Torsten, you just sat there nodding. You agree, don't you?
100%. I mean, let's look at the numbers. Non-farm payrolls in August was better than in July. The unemployment rate in August was better than in July. Average hourly earnings higher than in July. And you look at average weekly hours, also better than in July. I mean, this report is better than in July. This economy is not slowing down in the way that markets are anticipating. We will not get 8 cuts over the next 12 months. Here, you should instead look at this report as this is really telling you that there is a soft landing.
So help me with this. In October, when we look back at this report and we get another revision, a downward revision, don't we have to reframe some of this conversation and just say everything keeps getting revised lower? This is Lisa's point over the last few days. This economy, this labour market is weaker than we initially thought it was.
But GDP in the second quarter was 3%. It was just revised up. Jobless claims continues to be good. Continuing claims was also good. If you look at the daily data for how many people go to restaurants, how many people fly in airplanes, the weekly data from Redbook on retail sales, if you look across the board on bankruptcies, if you look across the board on credit card spending, in the aggregate, the growth data is just not showing signs of a slowdown. It is true that the labor market is weakening, and yes, the JOLTS data has been a little bit, maybe more in balance, as the Fed would be saying. But this whole notion that the economy is slowing down rapidly, it is completely misguided.
What I thought was fascinating, I was speaking to a number of retail executives at this conference this week, and their biggest question was, what's going to happen with the consumer? They didn't know. They had zero visibility. Even though you are seeing some trends, some signs of robustness, some signs of weakness, they said ultimately it just depends on whether they have the money to spend. These labor market reports are raising a red flag for a lot of people, saying if they lose their jobs, they won't. How fragile is that sort of happiness that you're describing to a scenario like that?
Certainly, if we do have a rise in the unemployment rate, so that's not what happened, the unemployment rate went down, it would become a problem. But if you also, exactly as you know too well, look at what they did say, the retailers, during this earnings season. Target said no sign of a slowdown, Walmart, no sign of a slowdown, and also Costco, no sign of a slowdown. You saw Dollar General, some parts of consumers are under more distress, but broadly speaking, looking at retail sales, both the monthly, the weekly, and across the board on credit card data, there is just no sign of a sharp slowdown. So the bottom line in this discussion is that you only get a recession when you have a really big shock to the economy. And that makes sense, of course, with COVID, Lehman Brothers going under, of course, the bust of the IT bubble in 2000. But this is not an exogenous shock with something coming from the outside. This is all engineered by the Fed trying to slow things down. And now the Fed is telling us that they're about to lower rates. So that's about to counter some of those negative things that have been weighing on the economy.
We get another headline from the Federal Reserve. Mike McKee from the New York Fed President, John Williams.
Yeah, John Williams is saying it is time now to join the party. He is not commenting in his prepared remarks about today's numbers. Of course, he wouldn't have had them ahead of time, but he does say it's time to cut rates. With the economy now in equipoise, which he titled his speech, that means in balance, and inflation on a path to 2%, it is now appropriate to dial down the degree of restrictiveness in the stance of policy by reducing the target range for the federal funds rate. So the guy who's vice chairman of the Open Market Committee is saying we're going to cut rates. He's not yet talking about by how much, but there is a Q&A, so we'll keep an eye on that.
And apparently owns a thesaurus, too, over at the New York Fed. Torsten Slok, what do you make of that, and what are you looking for from Governor Waller?
So I do think Waller will also give some more guidance in terms of what's going on, at least with the bigger economic picture. But I don't think that he will tell us much about whether this is 25 or 50. It requires probably a very important debate, given the spectrum of where FOMC members have been recently in their speeches. Some are clearly saying, some are even suggesting we should have much fewer cuts over the next several quarters. And others, of course, are suggesting that we should go much faster. So I do think that they need to gather in the room and think hard about, do we want to go towards 25 or 50? I would say, and I would agree with Mike, that 25 is the right number, given that literally everything in this report was better than in July.
Would it be a policy error, though, to go by 50?
See, that opens up the debate about our star and how far do we need to go down. If our star and where we need to go to, and ultimately, so real rates plus inflation, if we only need to go to 4.5, we're not far away from that, so there's no rush to lower rates. If we do need to go all the way down to 2.5 or 3, then there is certainly more of a rush. But given the incoming data across the board is still good, why is there this rush to cut rates so dramatically, other than the R-star framework, which says that we got to get going?
Jackson Hole's speech was all about understanding the effect that Fed policy has on the overall economy. The conclusion was we still don't know. We don't have a sense of exactly how quickly it gets sort of transmitted and how much of the lag effects that we're starting to see. There is an argument if you cut rates more aggressively now, you can get ahead of some of the lag effects that we haven't yet even seen. Why don't you give credence to that?
Because there are three very important reasons why we did not get that slowdown that we all anticipated for so long throughout 2023. Remember, they started hiking rates in March of 2022. First of all, consumers and firms had locked in low interest rates. AI investment has been very strong, and fiscal policy has been a huge tailwind. All these things combined have been the key reason why the economy has not slowed down. And those things are actually still in place. A lot of people still, of course, have low interest rates in mortgages, in investment-grade credit, fixed rate, also very locked in for a long time. So that means that if you do start cutting rates, it's actually the transmission is also going to be weaker on the downside. It was weak when you were raising rates. It's also weak when you're cutting rates. So because of that, AI investment still strong, fiscal policy from CHIPS Act, Inflation Reduction Act, and Infrastructure Act still strong. All this argues that the data will just continue to be steady over the next several quarters. There is no reason to expect this to be a hard landing. There is no exogenous shock similar to what we have seen during previous recessions.
Torsten, can we go back to the revision for a second? If you take off the 25,000 we took off last month and you do here for August, you'd get 117. Would you still feel this way if it printed 117?
Sure. Of course, the revisions are very important because we have seen some modest slowdown, but broadly speaking, the data was still better than what it was in July. So taken as the overall picture of, in particular with the unemployment rate, which is especially important when you put that into your Taylor rules and try to figure out what should the reaction function be from the Fed. And that's how all the regional Feds prepare the forecast. And if the unemployment rate goes down, it's hard to argue why they should be going 50. To go 50, you need some very, academic argument about our star, and you got to get going going with lowering rates very, very quickly. And the question is, with the incoming data being so strong, is monetary policy really so restrictive? It doesn't look like it's restrictive. If it was really restrictive, the employment report would be a lot weaker.
Pause, because this is exactly where I wanted to finish with you. You're saying 550 is still not that restrictive for this economy?
So if where we're going, the terminal rate is 4.5, is 5.5 far away from 4.5? I know we, have been somewhat, not quite brainwashed, but very distorted by a lot of FOMC members continuously saying we got to normalize rates, normalize rates, normalize rates. But let me ask you this, John. If we really had restrictive monetary policy, why have we for 2.5 years and counting still been getting very good economic data, including GDP in the second quarter at 3%?
The lags are just longer. They might say the lags are just long.
What should be the reason for that? The tailwinds from AI continue to be strong. The tailwinds from fiscal policy is still strong. We have locked in low interest rates for the consumer and for corporates. Where is this very significant transmission of monetary policy?
When we sit here and do this again a year from now, we'll do it before then, don't worry. In 12 months' time, where do you think rates are? They've got a 4 handle, they've still got a 5?
I think that they will be much higher than what the market is pricing at the moment, because this is not a shock that is generating a recession. Why haven't we had a recession for now 36 months and counting? I mean, it is really the case that the economy and the economic data has just been much better than what literally any model would have predicted, for the reasons that I just mentioned, namely locked in low interest rates, tailwinds from fiscal policy, and AI spending being completely independent of whatever the Fed is doing.
This is box office, and we should do it again next week. Torsten Slok,
I'm ready next month.
Looking forward to it. Torsten Slok of Apollo, thank you very much. So the data's better than expected. If you look at the totality of the economic data in this labour market report, the yields are still lower because this Fed is still going to reduce interest rates. Equity's just starting to inflect a little bit higher. The one thing I'd like to know, if you want tomorrow's prices, I want the close at 4 p.m. I want to know if equities actually close positive on this report.
Because then it's basically saying to the Federal Reserve they can cut by 50 basis points and still signal that it's not because things are falling off a cliff. This from Priya Misra. We will stay stressed out. Now all eyes on the Fed. The faster they normalize, the less they will have to do, and they can keep the soft landing alive. Don't know if they're there yet.
Up next on the programme, we'll set you up for the week ahead, a big week ahead. The debate continues. Nothing's been settled around this table. From New York, this is Bloomberg.
Every single thing I've done, it's almost as if somebody has said it can't be done. I mean, I remember I was in a factory and I said, I want to go in the night shift. And they said, no, we don't put women in the night shift. I said, how will I be a successful production manager or personal manager of a factory if I never went into a night shift and knew how a third of my people worked? So in some ways it has fueled some of my determination. It's fueled some of my, okay, I'm going to show this is possible, a sense of, I'm going to go get on and do it. It also gives me courage, because I feel sometimes I'm not just doing it for me, I'm doing it for everyone else who comes after me. And I always tell women who ask me for advice, saying, put your hand up for the most difficult job. Put your hand up for things that are challenging. You know, go in there and lean into things that are difficult, that are challenging, because that's what gives you the greatest credibility, respect, reputation.
Welcome to the world of decentralized finance.
We thought we'd take a look at Bitcoin versus the S&P 500.
Bloomberg's covering all things crypto, the people.
A tectonic shift emanating from Washington.
It's really a tale of two cities in crypto.
Crypto shouldn't be partisan.
The transactions.
Really a record-breaking moment. Crypto VC is back.
And the technology.
It's really the beginning of a global on-chain economy.
And if America doesn't embrace it, we're going to be left behind.
Bloomberg Crypto, Tuesdays, only on Bloomberg.
Jumpstart your trading day with 2 hours of single stock stories that are driving the opening bell action.
We'll take you to Wall Street, Main Street, the C-suite, and beyond.
Bloomberg Open Interest, weekdays at 9 a.m. Eastern, only on Bloomberg Television.
Everyone needs the weekend. Counting you down to the opening bell. 36 minutes away. The calendar looks like this. Today, Fed speak. Governor Waller, 11 a.m. Eastern Time. Ahead of the blackout period. This is really important stuff. before the Fed goes quiet. Monday, new iPhone from Apple. Tuesday, Vice President Kamala Harris and former President Donald Trump facing off in their first debate. Wednesday, the Fed's next big data point, US CPI. On Thursday, we'll get PPI plus another round of jobless claims and an ECB rate decision. And on Friday, Mitch, consumer sentiment. A final word around the table. Bramo, first to you.
Does CPI matter at a time where the focus is so squarely focused right now on weakening in the labor market? To me, that's my real question, and whether the Fed really leans into 50 basis points.
Particularly after wages came in just a little bit hotter than expected. AMH?
Bank of America saying after the most important NFP number, we have next week's U.S. presidential debate, next market catalyst. Will it really be a market catalyst? Do we actually get details from either of these candidates?
The last payrolls report going into that debate. Coming up on Monday, this is the lineup for you. Joe Quinlan of Merrill Bank of America Private Bank, Ed Yardeni of Yardeni Research, Sonal Desai of Franklin Templeton, Jim Bianco of Bianco Research. We said repeatedly it's a pivotal jobs report. It's decisive. It's settled absolutely nothing on Wall Street. The debate rages on.
And right now, this was not decisive for 25 or 50. It was not decisive for a neutral rate. To me, that will be an ongoing discussion. But right now, you see a labor economy that is downwardly weakening and that continues to do so. And to me, that needs to be really focused in terms of the balance of risks and how the Fed responds to it.
Those revisions appear to be a trend, which is why the New York Fed President John Williams has already come out this morning and said now is the time to reduce interest rates. Equity markets just about unchanged. The bond market is rallying. Yields are lower by 5 basis points. The 2-year is at 369. The 10-year is at 371. We have a normalizing yield curve. We'll leave that going into the weekend. From New York City, thank you very much for choosing Bloomberg TV. This was Bloomberg Surveillance.
Morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. markets close to the overnight session in Asia. We'll walk you through what you need to know to kickstart the European trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything.
Well, I think what's happening is we're starting to bring realism into the discussion. I mean, I think understanding the global energy system, the scale of that system, the important role that it plays in everybody's life around the world, and then thinking something that's been built over 150 years, trillions and trillions of dollars of investments that's playing such a critical role in the economies around the world, how you transition out of that system. And I would say transition from a higher carbon emission system to a lower carbon emission system. We started out with a very narrow solution set focused on wind and solar and EVs, and assumed or aspired that that would address the total set of the issues, and it doesn't. We need to be more realistic around, to Patrick's point, there are a lot of solutions that are going to be required. We should stay focused on the problem statement, which is emissions, and reducing those emissions, and less focused on exactly how to achieve that, and let every company, every sector, all technologies compete for the most cost-efficient way to reduce those emissions, and we will make progress much faster, which will mean making today's system more emissions efficient, while we introduce new systems that have lower emissions. And then with time, you will transition and we'll make progress.
What about artificial intelligence? Is artificial intelligence going to enable you and others to say, we have enough information to know exactly what something is going to be worth in terms of insuring it or not?
Artificial intelligence is finding its way into our business in a variety of different factors. I think the first piece is getting much better insight into data, which allows us to make better decisions on underwriting. It's also a great opportunity to service business better in terms of like call centers and different ways of what's using robotics and other AI will be very helpful. But it is an emerging practice within the industry, and one that is evolving very quickly. So it's also going to present risks that other companies, how they use it and how they use large language models, and making sure the decision making is very sound. So it's complicated, but it definitely is benefiting the business today.
on non-farm payrolls, but we're not seeing a big drop in futures. 30 minutes until the start of trading. I'm Matt Miller.
I'm Shanali Bassett.
And I'm Katie Greifeld. Bloomberg Open Interest starts right now.
Coming up, job jitters. U.S. hiring remained tepid in August, even as the unemployment rate ticked lower.
And now everyone is placing Fed bets. Billionaire John Paulson says the central bank has waited too long to cut rates.
We'll discuss all that and more with our all-star lineup of guests, including acting Labor Secretary Julie Su, BlackRock's Rick Reeder, and PIMCO's Tiffany Wilding. Let's take a look at where markets are trading 30 minutes until those bells ring. You have a little bit of a gain on the S&P 500 pre-market. We had been lower, now peaking higher after that jobs report. It did miss, but maybe not enough to indicate that the economy is falling off a cliff. That could explain some of the action here. The NASDAQ 100 still lower, and the bond market a little bit of a rally, Matt. The 10-year Treasury yield currently down about 3 basis points.
All right, the whisper number was lower than the 165 we expected in the survey. Here you can see non-farm payrolls growth. I will note that Mark Zandi told Tom Keene and Paul Sweeney on Bloomberg Surveillance just moments ago, you invariably see revisions higher from this August number because so many people don't report being on vacation in August.
Before we get back to the macro, we are going to talk about some pre-market movers on our radar. Broadcom shares falling, but not because of AI sales. It's actually because of the non-AI side of the business appears to be slowing in growth. Broadcom now down pre-market 6.2%. U.S. Steel, though, on the rise about 3.1%. Moving on news from its rival, Cleveland-Cliffs, whose CEO expressed interest in the company if the Nippon deal falls through. A big switch up in sentiment there. And sources say Intel is considering a sale of part of its 88% stake in Mobileye, and you have Mobileye down 3.5% pre-market, Matt.
All right, let's talk about U.S. hiring. Obviously, it's been the focus. We've been waiting for this jobs number all week long. It fell short in terms of the number we got for August. After downward revisions to the prior 2 months as well, we get more details with Michael McKee. He's our Chief International Economics and Policy Correspondent. So this is it. We waited all week for it, and really all month.
It's kind of a damp squib for people on trading desks because you're in the middle. You get good news on the unemployment rate. You get bad news or semi-bad news on job creation. Job creation, as you mentioned, just 142,000, and the revisions were important, minus 86,000. Last month, only 89,000 jobs created. The unemployment rate, though, falls to 4.2%, rounded out to 3 places, and you can see why, a significant drop from the prior month. Participation rate unchanged. Now, here's what happened with unemployment. The labor force did not expand as it has been. Household employment rose. The household survey unemployment fell. And so all of that combines to bring the unemployment rate down. Hours worked went up 34.3, which tells you that the economy is not falling off a cliff. Companies just aren't hiring. Same story we got in the Beige Book. We have had one Fed official, John Williams, the New York Fed president, vice president of the Open Market Committee, out this morning saying, with the economy now in equipoise, that was his word, and inflation on a path to 2%, it is now appropriate to dial down the degree of restrictiveness in the stance of policy by reducing the target range for the federal funds rate. He didn't say by how much. Maybe we'll get that from him as his comments go on, but now he is on board with a rate cut next week.
All right, Mike McKee, thank you for that, of course. You take a look at how markets are reacting, guys. Again, a little bit of a rally in the S&P 500. You could call it unchanged, though.
And big changes in expectations here for what people expect out of that rate cut. Potentially more cards now on that jumbo cut. And, of course, the 2-year yield really plunging here, about 5 basis points this morning.
Just dropping away. The floor is gone from the 2-year yield.
Yeah, it certainly has. Well, we'll keep an eye on that and more as we welcome now our Bloomberg TV and radio audiences. To parse this report, I'm pleased to say we welcome Acting Labor Secretary Julie Su. And let's just go through some of the numbers here. I know you're well aware of what happened at 8:30, but the unemployment rate, it actually edged down to 4.2%. That was its first decline in 5 months. Payrolls only rose by 142,000 jobs. That leaves the 3-month average at the lowest since mid-2020. So jobs growth, and it is growth, it's weakening. Is that a concern for the administration 2 months away from the election?
Hi, it's good to be here with you. I would say that this is another job report that indicates that we are continuing to see stable growth. Job numbers are still up. The unemployment rate ticked down slightly. As you've already mentioned, labor force participation remains steady. Earnings are up. This is a continued sort of the steady transition to an economy in which we're continuing to see people come into the labor market and find jobs, and it's a transition to more stability.
And I know that you're not going to opine on what the Fed should do from here, but of course the concern is out there that we could see this weakening turn into a real deterioration if we don't see the Fed lower interest rates from here. The current policy rate, do you think that that's out of step with the economic reality in the labor market?
No, and you're right. We don't comment on what the Fed will do. But again, I think overall, this is another month of many months in which I've come here and we've talked about how we continue to see job growth, right? The numbers are still up. We're continuing to see growth in various industries. We see construction, healthcare, leisure and hospitality, right? These are all signs of an economy reaching a normal, steady, stable state, and we want to continue to create the investments that are leading to this kind of job creation. And the president will be traveling to Michigan later today to announce an executive order that is ensuring that we're not just counting the number of jobs, we're also making sure that these jobs are good jobs where families can get ahead, where people can make a steady income, where they can retire with dignity. And so these are all part of the economy that the president promised when he came to office, and the economy that these numbers reflect.
Well, building on that, Julie, let's take a look at the specifics at the sector level, because you take a look at the manufacturing industry. It lost 24,000 jobs. The estimate had been for a reduction of 2,000 jobs. And actually, the last 3 of 4 reports, I believe, that sector has shed jobs. So what's the current view on why employment in manufacturing has been weakening?
So I would say cumulatively, again, the number of manufacturing jobs created since the Biden-Harris administration began is over 700,000 jobs. This is also part of the promise that we will make things in America again, from semiconductors to electric vehicle batteries. The idea is that American workers are the best in the world, and they can and should be making things. The investments that are going into communities are also, using American-made steel by American union workers, and raw materials mined by American union workers. And so, the job growth that we have seen, which again was not promised, most people predicted that it would not happen the way that it has, is not happening by accident. It's happening because of real investments and a commitment to job growth. So when you look at the overall trends, manufacturing has gone up since the president came to office. Construction had significant growth over this last month, and that is also no accident.
And I also want to get your perspective, of course, on some snafus, if you want to call them that have happened at the Bureau of Labor Statistics when it comes to data releases, because there have been a lot of questions about fair access and distribution of economic data following, of course, the February super users incident. We had the early release of inflation data in May, and then last month there was that delay to the payroll revisions figures last month. What steps is the BLS explicitly taking to address those missteps?
So the BLS has addressed those head on. We obviously believe in transparent and timely release of data to everybody. That is why I come on. That is why we release the data each month the way that we do. And so the BLS has attacked those issues head on to ensure that they do not happen again. The fact that some of the information came out not in the way that we exactly would have liked in terms of their timing of release, certainly, though, doesn't take away from the fact that this data remains the gold standard for how we judge the health of our economy, how we look at job growth, the unemployment rate, and changes to industries when it comes to the labor market.
Well, Secretary, I'd love to get a little bit more detail on what that looks like, that head-on addressing. I mean, are you considering going back to lockups? Are you potentially firing people here or hiring more? What does that look like?
I mean, we've definitely put in place, to the extent that some of them were technical issues, right, addressing those issues. Again, we are absolutely committed to timely and uniform release of data. Each of these incidents were really, different, but we are taking a systematic look at how to make sure that they don't happen in the future.
And while I still have you, I asked about hiring specifically because I spoke to former Fed economist Claudia Sahm the day after that payroll revisions delay, and she made the point that the BLS is underfunded. And of course, our reporting and other news agencies have reported something similar. So I'll put that question to you. Does the BLS need a bigger budget?
I mean, certainly nobody wants to see all parts of the Department of Labor adequately funded for the important work that we do than I. But I'll also say to that question about the Sahm rule and what it means, a lot of that is about looking at historical data to judge what is happening now. And I think what we've seen is that what's happened before isn't necessarily a good gauge for what is going on here today, right? The post-pandemic economic recovery, the historically low levels of unemployment for such a long period of time, and the investments that are being made that have really shaken up the job market in positive ways. And so overall, the many indicators are continuing to show that that the economy is growing and that the economy is strong. And either way, obviously, it's important for us to keep on reporting the facts as they come out.
Secretary, really appreciate you taking the time on what I know is a busy morning. Our big thanks, of course, to Acting Labor Secretary Julie Su. Meanwhile, let's turn this conversation back to the markets right now. Of course, the S&P 500 pretty much unchanged in pre-market trading. You take a look at the bond market right now. You have yields inching a little bit higher here. We have the perfect guest to unpack this all with, Rick Reeder. He is the CIO of Global Fixed Income over at BlackRock. He joins us now. Rick, great to see you again. You take a look at this market reaction. I know that you would have cut rates back in June, but you take a look at what the Fed is facing 2 weeks from today. Do you think that they should go 50?
Well, I've learned in my career to not invest based on what I would do. It's like you got to follow what they're going to do. And listen, I mean, I think they should go 50. Do I think they're going to go 50? I mean, we got an inflation report next week. I mean, that's going to be important. Listen, I think they're going to err on the side of doing 25s and stay down the fairway. I don't agree with that. I think the funds rate at 5 3/8. When you've got inflation running, we said we're going to get the data. But the last 3 months, you take the high-frequency data, core CPI is running at under 2%, 1.6%. You strip out shelter, it's actually negative, and we know shelter's coming down. 5 3/8 is the wrong price. I think they should get there sooner. My sense is they're not in as much of a rush, and I don't think they learned that much today. You've got a slowly deteriorating labor market, but the slope of the line is just not that intense, and so. It's should they go 50? I think they will do, or I think they should. Will they? I don't know.
Rick,
I don't know. I don't know.
To that end, I'm curious about how you see the market pricing adjusting here. If you look at WIRP on the terminal, you have more than 118 basis points worth of cuts priced in through the end of the year. Is the market overcorrecting?
Listen, I think it's aggressive. Yeah, I think it's too much. That being said, I know we've talked about it before over the last couple of months. I like owning yields in the front to the belly of the curve, but I think what has happened is the front of the curve, exactly what you're pointing out, has moved to very aggressive levels. I think what people should do, and we talked about this the last couple of months, we're going to lose that. You've been able to sit in cash at 5 1/4 and just sit there. And by the way, the last couple of years, the trade has been sit in cash and NVIDIA, or cash and AI, or cash and tech stocks. That cash is coming down. And so I like the idea of, gosh, lock these yields in, hold the belly of the curve. I think people will be comfortable. You've seen the last couple of days, all of a sudden it's like, I got to get these yields for a longer period of time. That to me is the obvious trade. And that is the one, like, you can still get fixed income and build a portfolio with yields above 6% because the funds rate is 5 3/8. I mean, I think we're going to be a year from now, people are going to say, remember, we got to do that. That's where I think the trade is.
Yeah, I have a bond fund manager writing in, Rick, and he wants to know if the yield curve is really going to go positive and stay that way in the next 36 months. Can the long end stay below 4?
So I'm going to say it's a great question. So I'd say a couple things. One, I think the curve will steepen. like I said, I think the front end now is pricing in an awful lot. But I think the curve will steepen. I think that 5-year point is where you've still got some gearing to the Fed cutting rates. The long end of the curve, so if you take and you go back and say, okay, what should the long end of the yield or the long end of the yield curve be? Let's start at the 10-year point. 10-year point, if you got nominal GDP running, let's say we're running 1.5, although we just printed 3. You got 1.5 nominal GDP, you got inflation, let's say it's 2-ish, although we're trending a little bit lower. Listen, I don't think that 10-year is that far off of, should we be 3.5 to 4 in the 10-year? I don't think we're going very far from there. Back end of the yield curve, I don't know why, you don't really need to own it. And so, my view is, the long end, there's a pension bid, there's a life insurance bid. There's not that many long bonds in circulation after what the Fed owns and pensions own. So, I think people put on the steepener trade, realize there are not that many long bonds. I just think the long end of the curve is like, it's not, like in a portfolio construction today, A, it's not a hedge, and B, like, why do you own it? Just clip all the yields you need in the belly and carry on.
All right, Rick, we're going to hold you over. We want to talk a lot more with you. Rick Reeder of BlackRock is going to stay with us. I want to get a quick check on futures now. We've seen them in the green on the S&P, and we are up on futures 0.1%. So
that's so exciting.
You're more excited about that than Shonali is about the 2-year falling
the 2 basis points
below 365. NASDAQ futures down 0.1%. Russell futures down. Look, they're not moving that much, but as we get closer to the open, maybe we see a little bit more movement after that number that we've been waiting with such extremely bated breath for. This is Bloomberg.
We invest in, buy, and own the backbone of the global economy. When the water gets delivered to your house, the road you drive on, the pipeline that brings different things to your community, the telecom towers that transmit your phone, the data center, the real estate that you live in. It's what we own and build, so it's really what drives the economy, and you don't often see our name.
Is that a good or a bad thing?
It's just because we're behind the scenes, but it's big. With $1 trillion of assets almost, we're behind a lot of the things of the global economy.
So being low-key, do you think it gives you strength?
We just try to be quiet and do our thing, and sometimes it helps and sometimes it doesn't. But I'd say on balance, it's been good for us.
There is this real momentum from Wall Street.
We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
All right, quick check on futures here. We're really not seeing a lot of movement. For all the hype behind this non-farm payrolls number this morning, it didn't deliver in terms of market reaction. S&P futures are basically unchanged. I mean, up 0.1%. NYMEX crude, I'm looking through assets across asset classes for movement. NYMEX crude, I see a little there, so oil up 0.5%. The dollar is doing a whole lot of nothing. The 2-year yield is down 4 basis points.
But 20 basis points on the week.
But 20 basis points on, no, you're right. I mean, it is a 370 handle, a 360 handle is a pretty big surprise there. We are back with Rick Reeder, CIO of Global Fixed Income at BlackRock. Rick, where could we see some real movement here? I mean, especially given the volatility that we are expecting in this period. You know, September is a horrible month, at least for stocks. We're getting close to an election. Where are you braced for some real movement?
So, Matt, I would say one thing that I think has been this weird conundrum. I know Katie and I talked about it the last couple of months. Rate volatility is very high. And actually, I mean, you look at, like you were saying, it's not really moving that much. I mean, by the way, it was a historically high rate vol pricing into this number. And then obviously that's melting away. Equity volatility has been really low in terms of what the markets are pricing into the options market. Listen, what should happen? So if you think about the multiple in the equity market today, you're pricing a PE of 24 and change with an economy that's slowing, and you've got an election with uncertain results. It's just been a conundrum why equity volatility is so low and rate volatility is high, given you've got a Fed that's pretty deliberate in what they're doing. I think that equity volatility has been a gift in how cheap it is. I think you'll see gyrate like you've seen. I think you'll see gyrating of the equity market. You know, you look at some of the tech names over the last few days. I know we have Broadcom today. Listen, I mean, to price PE ratio and technology in the mid to high 30s, you got to get earnings growth that is dramatic to get there. So I still think that the equity the volatility of the equity market is where we're going to see, and particularly in tech, is where you're going to see some movement here.
Well, Rick, that's really interesting. Just to crystallize that point, I was going to ask you how those two lines come back together, bond vol and equity vol. It sounds like you don't see bond vol necessarily calming down here. It would be a catch-up of equity volatility.
No, I think it's coming down. Rate vol's coming down a lot now this morning. I think, part of when you think about portfolio construction, things like agency mortgages that, people worry about volatility. I think rate vol's coming down, and I think rate vol will come down. And then, I think equity vol, it moves around sporadically, but then you get this period where people feel sanguine about where we're going. And I mean, we were doing S&P call spreads when vol was under 9. And, now obviously we've moved up a little bit. It doesn't, that stuff doesn't make a lot of sense. So I think the idea is rate vol will come down. I think equity vol will be erratic, and then you buy it when it comes down.
All right, so there's the playbook there. I want to ask you about where you are on the curve. I know that you've been in the belly for a while. That's been the sweet spot when it comes to the Treasury curve. Are you still there? Are you thinking about extending duration now that we have a much clearer picture of where the Fed is going to go?
No, I mean, so we've been front to belly for a long time. And the one thing that I think is, letting some of the front go is, we still are in the front. But, it still carries pretty well. And if you think about where we're going to be, but, do I like letting some of our, this front end position we've had, should we let some of that go? Yeah, I think, and we have. Do you let some of that go? I think so. There is, people are building in a pernicious deceleration of the economy. I think the economy's slowing. I just don't think it's that dramatic. So let a little bit of the front end go. But no, I still like, to me, if you can buy yield, and use the high yield market, use the securitization market. We talk about agency mortgages. Europe, where you look at some of the data in the economy in Europe, and particularly today, slowing European rates. I still like that. I still like buying these yielding assets and clipping coupon. Like if we can clip, so go back. If the equity market, if return on equity is coming down, let's say in a slowing economy, return on equity is 8 to 10%. If I can buy fixed income and sit in yield at 6.5 or so, like that's pretty good. That is pretty good.
Rick, it's interesting. If you look at the movements in the bond market this week, this was really supposed to be the moment of the week after the payrolls data, and you did see a move, but really you saw bigger moves earlier in the week off the heels of other economic data that showed weakness. When you read the path forward and you're looking at the manufacturing data and the services data and the payrolls data, what is going to matter most to you to give you a picture of what this economy looks like and what's slowing down more than others?
That's a great question. So, by the way, I think surveys, I like the hard data. The reason why today's number is so important, it's hard data. Like, I think the surveys, people, say what they think they should do, but they do. What they actually do is more important. So I love earnings reports. Listen, you've seen some some retailers with some pretty harsh numbers. I've talked a lot about low income. You saw that, it was $1. You saw a bunch of these companies. That to me is real data. And then, you got to focus on what's happening, the consumer, credit card charge-offs, auto loan delinquencies. That to me gives you a pretty good indication of, you got parts of the economy. We've talked about lower income that's struggling a bit. The other thing that I'm going to really focus on, CapEx and R&D spend. You have concern about global trade, what happens with tariffs. Are companies going to start pulling back? Because much of what's buoyed the economy, spend on R&D, spend on AI development, software, that's going to be really big. So how companies articulate, do you wait? Do you pause a little bit to get more clarity? Right. That's going to be a big deal to watch.
Rick, we only have a minute left here, but I'm very curious about your thoughts about the political ramifications of what happens in the bond market. We spoke to John Paulson yesterday, who's an informal economic advisor to Donald Trump, who says he will lower interest rates, which of course we know he personally can't do. Only the Fed could do that. Yet Paulson believes we could end next year as low as 2.5%. What do you think of that call?
So I think rates should be lower, and there are a variety of reasons, and I think if some of the motivation for that is because we've got a debt burden in the country that's too high, I think it's right on path in terms of we need to get the rate down. I think, like I say, 5 3/8 funds rate's not the right level. We need to get the rate down. Do I think we're going to go that low? Listen, the data doesn't suggest we need to go that low. I think the terminal funds rate is higher than that. But listen, is the trend, particularly in the front, we talk about the belly of the yield curve, that we get rate lower? We actually have to get it lower because if you look at the debt service on the country, I think a year, 2 years hence, people are going to realize that debt service is a tough dynamic for the economy.
I realize it already. I talk about it every day.
There you go. Rick Rieder, it's always great to speak with you. Really appreciate you taking the time on this busy morning. That is Rick Rieder, of course, of BlackRock. Now, coming up, less than 4 minutes to the opening bell, we'll start the trading day with Greg Bottle of BNP Paribas. That's next. This is Bloomberg.
How can you have dinner with friends without hinting at what you're thinking about? And do you ever get suggestions from your friends at dinner, this is what you should do? And how do you respond when they kind of say, maybe you should lower interest rates? You just keep eating or what?
You might define the word friend to mean doesn't ask you about interest rates. So, no, people don't do that generally. People I don't know will always say, hey, cut rates. Somebody said that in the elevator this morning.
Did that influence you or no?
I said, thank you, sir. And no, but I mean, people say things, but it's fine.
So in some parts of the society these days, people are making decisions based on something called artificial intelligence, AI. Have you thought about, calling up ChatGPT and saying, here's all the data we have. What do you think about would be a good idea? Have you ever thought about that, or they're not going to likely do that?
We haven't done that. I mean, we have done little things like we've asked ChatGPT to generate questions for the press conference. And I'm happy to report for any journalists who are here that the questions were not as good as the ones we get from real journalists. So,
what about my questions? How do they compare to my questions? Okay.
No comment.
Right, so they weren't that great. Okay.
Bloomberg Surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern only on Bloomberg. Context changes everything. It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg.
We are moments away from the start of trading on this hallowed non-farm payrolls day. This is Bloomberg Open Interest. I'm Matt Miller. You can see that futures are really doing a whole lot of nothing, even after a miss on non-farm payrolls. Maybe that's because, bad news wasn't bad enough to spur a 50 basis point rate cut. You can see the New York Stock Exchange here ringing the bell. Down on my over my right shoulder is the NASDAQ, and we're still over 100 points, 170 points basically away from an all-time high. Interesting note from Ned Davis out today saying that the volatility, the drops that we've seen here, we're still in the midst of a correction, but in a bull market. So let's see if any of that plays out today. Let's get over to Katie Greifeld right now. She's got a check on your major averages. Katie?
All right, like you said, a whole lot of nothing, but let me try to sell this. You take a look at the S&P 500 right now. It's up. We haven't seen that in a while. We know it's been an absolutely brutal start to September, to this trading week, but today, a little bit of relief on the S&P 500, up 0.1%. Not quite there yet when it comes to big tech. The NASDAQ 100 down about 0.1%, and small caps actually peeking into the green as well. The Russell 2000 currently up about 0.1%. Let's get over to some individual stocks that we're keeping an eye on, and up first, Broadcom. Shares down bigly after offering a disappointing sales forecast. Analysts noted that the company's non-AI portions of the business are growing more slowly than anticipated. That is not what traders wanted to hear. Shonali, shares currently down about 7%.
Bigly, I want to keep that word in this program, Katie. I'm also keeping an eye on U.S. Steel after the CEO of rival Cleveland-Cliffs said he was absolutely interested in bidding for the company's assets. You now have U.S. Steel up about 2.4%, and Cleveland-Cliffs roughly unchanged this morning. Remember, though, the Biden administration is preparing to block the $14 billion Nippon-U.S. Steel deal, and that Cleveland-Cliffs attitude is a real change in tone, Matt.
All right, Intel is considering options for its really large stake in a company that's gotten a lot smaller, Mobileye, the struggling automatic driving software startup, according to sources. Intel holds actually an 88% stake in Mobileye, which was a massive company, but now it has a market value of only about $10 billion. Let's get a closer look with Abigail Doolittle. Abby, what do you see?
Well, it is a really large stake. It's almost the entire company, as you were mentioning. Intel has an 88% stake in Mobileye. And earlier today in the pre-market, Intel had been higher on this news, the idea that they are considering lessening that stake. There's going to be a board meeting of Mobileye here in New York later this month where it will be discussed. Mobileye down 6.1% off the lows. It's been down somewhere between 2 to 3% to closer to 8% or more on the possibility that Intel could offload this stake. And it's interesting because they offer software and hardware for self-driving automated systems. And because of the pandemic supply gluts, that has really hurt Mobileye. And so this is some of the facts that we were just talking about. In addition, it's interesting because they have a network and edge business, which has suffered big declines. Last year, they saw revenue for their network division fall by about a third. They're considering options there, and they're also considering a split of some of their product design and manufacturing. So Intel, which is down about 60% on the year, in a world of hurt, trying to produce and turn around. Mobileye, you can see here the revenue on a year-over-year basis. The first quarter of this year down almost 50%, and then this third quarter estimate down 8.4%, 16%. Any way you take a look at this, Shonali, it is not good, and this helps to explain why Intel may be considering or is considering unloading some of that stake in Mobileye.
Abigail, we appreciate it. Thank you so very much. We're going to now bring in BNP Paribas U.S. Head of Equity and Derivative Strategy, Greg Battle. And you look at the S&P 500, and after 3 weeks of gains, you are seeing red on the screen for the S&P 500 this week. Tough way to start September. What does sentiment look like now going forward after we've seen a little bit more of a drawdown?
I think it's really mixed, and you see that looking at the options market relative to the spot market. So coming into today, we have the S&P just below all-time highs, but the VIX in the 20s. I think one of those two things has to give. Either we're in a more Goldilocks environment and that VIX and volatility is going to mean revert, or you're going to see an S&P correction.
Yeah, we were basically at an all-time high on Friday, right? I mean, near as damn it to it. And we've been down every single day this week. Okay, there was no trading on Monday, but I think into the payrolls number, this market has been so bearish. Why do you think that is if we're getting set up for a rate cut?
So I think when you look at rate cuts historically, you tend to get one of two things. Either a preemptive rate cut that drives great returns for equities. So you could think of 1995, 1998, or 2019. Rate cuts followed by double-digit returns from equities. But you can see the converse where the Fed start cutting, and they're cutting for a reason, that things are slowing. And the start of Fed rate cutting cycles, think 2007 or 2020, have been around some of the deepest, most volatile drawdowns we've seen for equity markets. So really, it's less about...
Those were crazy times, dude. I mean, we're looking at 3% GDP growth and 4% unemployment. Inflation's a pretty mild 2.5%. Things look good.
In the rearview mirror.
Yeah.
So I think the important thing is the trajectory of the data, and we all know that the data is slowing. Yeah. And the question is it slowing in a benign fashion in which those Fed rate cuts will be welcome and it will help the equity market, or is it slowing in a way that it could accelerate? And I don't think the data that we saw today answers us one way or the other.
So what do you do with that? I mean, do you shift to a more defensive stance in your portfolios? When you look at the rear view, obviously tech has been the big winner, even with the last few weeks. Do you sell out of that? What are you doing here?
I think being more defensive is prudent at this time, but the way we do it is via the options market. So when we look towards what we have in the remaining kind of calendar year, next week we have a presidential debate. After that, we have the FOMC, the first rate cut of the cycle, with expiry. A couple of weeks later, earnings season kicks off. You see Broadcom getting stocks moving again this morning. And then you have the election itself. So there's a huge range of potential endpoints this year and a huge range of potential paths to get there. So owning optionality, we think, is the best trade into the back end of the year.
So we were having this debate this morning. We love to do this thing where each of us kind of take a side on something, and then we ask our guests to settle the score. How much does index rebalancing matter to this market heading into that rebalancing rather than coming out?
Especially considering this is a different rebalancing, right? Because Berkshire Hathaway, Buffett, they dumped a ton of Apple shares, which is a gigantic company. It's not the same as like triple witching, right?
Yeah.
I think index rebalancing can matter. It can matter for stocks. It's things that people can trade around. But where we end the year isn't going to be driven by index rebalancing. It's going to be driven by corporate earnings, the election, and the path to macro data.
So did we all win then? I feel like...
No, I feel like you came out on top. Katie said there's like a glitch for 15 minutes.
Here's the market. Is it a trader's market or an investor's one right now, given the volatility that we have?
I think it's a trading market. So you just look at the path of equities over the last 6 weeks, from all-time highs back down to 5,100, back up to touch all-time highs. So there's plenty of opportunities to be nimble and make money, and there's plenty of opportunities to be wrong.
Can I get your take on earnings? I mean, people tell us also that presidential elections, while we love to talk about it and it's sensationalist a lot of times, especially with one of these candidates, it doesn't really matter, right? Earnings is what really matters. And we were up, what, 11% on 12% on corporate earnings in the last quarter? Sales were up 5.5%. I mean, things look strong. Are they going to finish out the year that way?
Yeah, so valuations are elevated, so I think earnings need to be strong. The question that people will be looking at, again, is that kind of second derivative. It's similar to the macro data. Are things cooling slowly or are things cooling quickly? I would challenge you a little bit in terms of, do elections matter for stocks? If you go back to the 2016 election, small and mid caps, the Russell, IWM, it had 15 consecutive up days around the election. So there is definitely room for rotation, different relative winners and losers based on the outcome of the election.
So how are you playing that potential for rotation? I mean, is that something where you're going actually into the stocks, into the indexes, or are you also taking that options-based approach?
Yeah, so again, I think it's an options-based approach. The real challenge of trading the election now is there's an awful lot of water to come under the bridge in between now and the election date. So you can get the election call right and be very wrong in between. So I spoke just now about the reaction that Russell had to the 2016 election. I think it's probably the most election-sensitive ETF or major index that we would look at, but it's also very sensitive to the macro data. So if we had a further cooling of the macro data, weakness heading into the election, we think the Russell will be very sensitive to that, and we think it will be sensitive to the election outcome. So we think optionality on the Russell is probably one of the best ways to play directional trades, be them bullish or bearish.
Which president is better for the Russell? I mean, is this a situation where you want a president who feels the need to intervene in the rates picture, where somebody wants lower rates? John Paulson told Chanel yesterday 2.5%.
Or one that lowers the tax base for small businesses.
And taxes on realized gains.
Right.
If you have an environment where you have a presidential candidate talking about lowering corporate tax rates and focused on domestic policy, that's something that's going to be good for small and mid caps. We saw the reaction post the 2016 election where the best performing pocket of the market was the small and mid caps. So I think for us, that's the part of the equity market that would be most reactive to that outcome.
Okay, so on that note of lowering tax rates, you have former President Trump telling people that he will lower the corporate tax rate to 15% if you manufacture in America. But if you manufacture in America, does that raise your costs otherwise?
Potentially, but I think the knee-jerk reaction to the market is not necessarily going to be what's legislated. It's what's going to be talked about.
It's the direction, right?
We have that election at the start of November, and the price action through December and January is going to be based on that rhetoric there. So if we're leaning towards helping out domestic U.S. corporates, then something like the small and mid caps is a very domestically orientated index versus something like large cap tech, which is much more multinational and has much lower effective tax rates already.
All right, Greg, it's always great to see you. Really appreciate you taking the time out of a busy morning. Have a great weekend. That is Greg Bottle. He is BNP Paribas U.S. Head of Equity and Derivative Strategy. Now coming up, the hits keep on coming for Supermicro as it gets a downgrade from JP Morgan. Details next. This is Bloomberg.
We felt strongly that there has been an opportunity for there to be an experience on mobile that is centered around gamers. Like, we talk a lot about how there's 3 billion gamers in the world. 2 of those billion play on mobile, and half of those actually play on mobile and they play on another device. But there isn't actually a gaming platform and store experience that is centered around players and goes truly across device, where who you are, your library, your identity, your rewards, that it travels with you versus being locked to a single ecosystem. And we've recognized that opportunity for a long time, but we wanted to make sure that anything we built was really grounded in people who play those mobile native games and the creators of them. And so being joined with a team that has real deep expertise in mobile was important to us.
Lots happening on Wall Street.
I couldn't have been more wrong.
It's going to stay volatile for a while longer.
It's a bifurcated market.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insight.
Year over year, you could start to see some cracks.
It might be overhyped short term, but it's underhyped long term.
From businesses most influential and instrumental.
A lot of the doom and gloom has been somewhat overblown.
If you're not living near the edge, you're taking up too much space.
Bloomberg Wall Street Week, live tonight with replays all weekend on Bloomberg Television and Radio.
From our world headquarters in New York, I'm Menace Credit.
And I'm Danny Berger. Let's set your agenda.
Bloomberg Brief delivers the market news, data, and analysis you need live every weekday at 5 a.m. Eastern. Bloomberg. Context changes everything.
It's the countdown to the market open as we bring you the first trades across Europe.
We'll debate the most important stories and what will drive the big investment decisions throughout the morning. I'm Guy Johnson.
I'm Kriti Gupta.
And I'm Anna Edwards. Join us every weekday morning for the opening trade, live at 7 a.m. here in London.
Only on Bloomberg. Context changes everything.
This is Bloomberg Open Interest. Quick check on some of the individual stocks trading just minutes after the open, 13 minutes in, 14 minutes into the session. Look at Mobileye there. Down another 9%, hitting a record low today. The report's out that Intel, considering a sale of some of its massive stake in Mobileye, Intel owns 88% of this company, but it's worth less now than $10 billion. So tough time to sell for a company that got in much higher. You're supposed to buy low and sell high. Broadcom down 10% after earnings that didn't miss. The forecast for $14 billion in sales was less than the $14.1 billion in sales that the street was looking for, but that's not, I wouldn't say a huge miss. Nonetheless, a concern about their non-AI business decimating the market cap, and then Nvidia down 1.3%, a smaller drop, but a much bigger company, so will affect the indexes. Katie?
All right, it's time now for our top calls. Some of the analyst action in focus this morning. And first up, JP Morgan says that Supermicro is no longer a buy, downgrading the server company to neutral, slashing its price target nearly in half. The move comes, of course, in the wake of the company's delayed 10K filing. Usually that's not a good sign. And as such, the analyst recommends that investors remain on the sidelines until the company is back in compliance. You can see shares down 4.5%. Next up, Barclays says that Robinhood is no longer a sell, raising the stock to equal weight. The analyst says that the company has matured and sees potential sales catalysts from new products and regulation. Barclays also upgrading Coinbase for the same reasons. And finally, Frontier Communications no longer a sell, according to Wells Fargo. The firm is upgrading the telecom company to equal weight following its deal to be acquired by Verizon. The analyst says that the deal was a, quote, fitting end for Frontier, Shanali.
And coming up, the Fed should cut rates around 3%, maybe 2.5% by the end of next year. That's according to John Paulson. We're going to hear more from our interview with him next in our Wall Street Beat. Stick with us for that conversation next. This is Bloomberg.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm Stephen Engel at the Forbidden City in Beijing, and this is Bloomberg.
Always on the heartbeat of the tech sector.
Spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure. Don't miss Bloomberg's interview with the
Today's CFOs are reshaping the C-suite. Bloomberg's chief future officer shines a spotlight on these dynamic leaders. Healthcare giant Johnson & Johnson is staking its future on innovation. Making investment decisions under pressure has become business as usual for CFO Joe Wolk.
The world is coming at us faster than it ever has. We're getting information more quickly. We're going to have to move faster. The competition's moving faster.
Watch Chief Future Officer Wednesday, only on Bloomberg.
This is Bloomberg Open Interest. Let's take a look at the stock market about 18 minutes or so, 28 minutes into the U.S. trading day. You have the S&P 500 actually in the green right now. The NASDAQ 100 not exactly there. It's actually deepening losses because we have those losses in Broadcom, in Tesla, in NVIDIA. That is all weighing down on your big tech benchmark. Meanwhile, you take a look at the Russell 2000, your small caps, up about 0.3%. It's your winner right now, Shonali, but, you know, the day is young.
The day is young, and it is long indeed. We're going to also talk now about the Federal Reserve, because expected to cut rates in a couple of weeks, of course, and some in the market think they've waited too long. John Paulson spoke to Bloomberg to tell us exactly that.
The immigration policy is a negative for our economy. If you look at New York City, we have hundreds of thousands of immigrants, which are costing the economy valuable resources that existing taxpayers are paying for. So we have to provide health care benefits, housing benefits, food benefits, and these workers aren't allowed to work. So I don't think the illegal immigration has been a benefit to American workers. It increased the supply of cheap labor, which held down wage growth for American citizens.
But wage growth has been part of the inflationary story, has it not?
Wage growth has been grown less than inflation. That's why real wages have declined.
I also want to talk about interest rates, because at the end of the day, there has been a lot of concern on Wall Street about what a Trump administration would mean when it comes to the Federal Reserve. There was, of course, that Wall Street Journal report a number of months ago that questioned whether the Federal Reserve would remain independent. And then we also had the former president commenting in an interview with Bloomberg as well, saying that the president can certainly be talking about interest rates because he has good instincts. That doesn't mean he's calling the shot, but it does mean he should have a right to talk about it like anyone else. Do you share that concern that he could potentially damage the reputation of the Federal Reserve as an independent organization?
No, I don't share that concern. I think it is important for the president and the White House and the Treasury Secretary to comment on economic policy, including interest rate policy. But ultimately, the decision is up to the Fed. But it's important for the Fed to hear other viewpoints and to make sure the Fed policy is in sync with overall fiscal policy.
To that end, what do you believe should happen with interest rate policy through the end of this year?
Well, when you look at inflation now is somewhere around 3%. Interest rates are 5%. So real interest rates are too high. So the Fed, I think, waited too long to bring interest rates down. So I think the likely course of action is going forward is the Fed will start to cut interest rates.
What should they be by the end of 2025?
It's difficult to predict, but my best guesstimate would be around 3%, perhaps 2.5%.
2.5% to 3%. That's where John Paulson thinks rates will end up by the end of the year. Now, time for Wall Street Beat, because former President Donald Trump made his bid to Wall Street and New York's business elite at the Economic Club of New York yesterday. And here is what he promised if he wins in November.
I am promising low taxes, low regulations, low energy costs, low interest rates, secure borders, low crime, and surging incomes for citizens of every race, religion, color, and creed.
Joining us for more on the candidates' economic plans is Bloomberg Politics editor Laura Davison in Washington. And this was a really interesting moment right before that debate next week expected between former President Trump and Kamala Harris. But let's talk through first the reaction from Wall Street to that speech yesterday, because there were really mixed emotions, weren't there, Laura?
Yeah, there was really a sort of a difference in tone here from where the president has been. He was going speaking in front of a bunch of business leaders, many of whom are not used to hearing Trump speak. So some are very surprised to hear sort of the proposals he has and sort of the way he talks about it without some of the specifics. But others, there were many Trump allies in the room, like John Paulson, like Scott Bessent, who said, look, this is the plan we need. We need to move forward with very low interest rates, very low taxes. What Trump did not talk about about specifically, though, is how he intends to achieve some of those things. The president, cannot lower interest rates. That's the Fed's job. Lowering taxes. He needs Congress to do that. Energy prices, also something the president doesn't have direct control over. So those are the policy details that Wall Street is looking to see kind of how he might go about doing that.
I mean, they all need Congress to play along. And it seems like he laid out a lot more in terms of proposals than the Harris-Walz campaign has laid out. I was also surprised, Laura, by such a warm reception, such a positive reaction by all that were in the hundreds of like the masters of the universe were there, and he got applause at many moments in between. So I thought it was pretty positive reaction.
Yeah, there were about 650 people in the room, which shows that people are not shying away from this event, that they are going. They want to make sure they're there because there is a chance that a very strong chance that he is the next president of the United States. Harris has been gaining on him in the polls, but this is a very, very tight race. And I think business leaders, as they're planning ahead, are looking, that there could be a lot of different outcomes in this race, both at the White House as well as the congressional level. And because 2025 will be such a big tax year in Washington, big swaths of Trump's tax cuts expire, which means that there will be an all-out fight, both from everything from capital gains to the corporate rate, that they want to make sure that they're prepared and positioned for what could happen.
And so set this up in terms of the debate that we're finally going to see next week. Of course, Kamala Harris and Donald Trump facing off. How much substance are we expecting when it comes to some of the economic policy proposals that we're talking about right now?
In short, not a lot. Neither campaign is expected to come to this debate, to have new policy proposals that they're going to roll out during the debate. Instead, what both campaigns are doing is trying to make sure that they come out looking strong, that they land those zingers, that there are, small little moments that can get shared on social media. This is not expected to get into the weeds of, budget policy or any of that. This is more about overarching themes. And this is really sort of a difference from Biden to Harris. If Biden really wanted to campaign on the details, Harris is much more interested in campaigning more on a message and a vibe.
All right, Laura Davison, really appreciate your reporting as always. And of course, Bloomberg Television and Radio will have special coverage of ABC's presidential debate between Vice President Kamala Harris and former President Donald Trump from 8 p.m. to 11 p.m. Eastern on Tuesday, Matt.
All right, we will, most of us will be watching that.
Or asleep.
It's kind of late, right?
It is a little late.
For those of us who have to get in the office early.
We'll be paying attention. That is the catch-all for
stay up and watch it.
Saying you might watch the clips the
I
next
definitely
morning.
am glad I watched the last one.
I'm glad we were both, you were there. I got locked out of the event yesterday.
There were things that caught a lot of us by surprise last time. Coming up in the next hour, Tiffany Wilding of PIMCO reacts to the jobs print. Then DraftKings CEO discusses the rise of sports betting as NFL football season begins. And Lending Club CEO prepares for interest rate cuts to impact his business. This is Bloomberg.
What would you say somebody young who's watching this should do if he or she aspires to be like you?
There's one component of our industry that people need to focus on, and it's not technical, and that's communication skills. Focus on being a phenomenal communicator, invest in that. Think about it, we have to convince a company to sell to us. You just don't walk in and buy the stock or tell them, yeah, you're for sale, I'll pay you this price. That takes years of relationship and effort. Why would somebody sell you that billion-dollar software company growing at 20%? Just because? No way. People hang on to these great assets. And then how do you get on the same page with the executive team of that company, even if they're existing or new. It requires just amazing communication.
If you go to a cocktail party and somebody comes up to you and says, I have $100,000 I'd like to invest, what do you would recommend that person do with $100,000? What do you think is a good idea to do with $100,000 today?
Sometimes they do, and I give them the most boring answer ever, S&P 500.
Just buy an index.
Buy the index. You don't have to worry about the quarterly earnings of a company. Did something change? Did somebody change management? You don't have to make this your full-time job. Just buy the index and you're going to be okay.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg. Context changes everything.
All right, we are 30 minutes into the trading day. Welcome to Bloomberg Open Interest. I'm Matt Miller.
I'm Sonali Bassett.
And I'm Katie Greifeld.
Coming up, job jitters. U.S. hiring remained tepid in August as the unemployment rate ticked lower.
The jobs data puts a jumbo Fed cut in play. Traders are pricing in a 50-50 chance of a 50 basis point cut this month. That's exactly what they were doing yesterday at this time.
That's totally right. But speaking of bets, the rise of legal gambling is changing how millions of Americans root for their favorite teams. We'll discuss with DraftKings CEO Jason Robbins as NFL season kicks off. Meanwhile, you take a look at these markets. We're now 30 minutes into the U.S. trading day. I triple-checked. You take a look at where we are. Actually, now we're flipping back to red for the S&P 500. Same thing, too. If you take a look at the NASDAQ 100, losses accelerating here. Of course, a lot of your big names are lower right now. You think about that wipeout underway in Broadcom, certainly not helping here. Tesla, too. Then you take a look at the bond market. You're not going to find a haven there necessarily because 10-year yields now higher on the day, not by much, but still up 2 basis points when it comes to that 10-year Treasury yield. Meanwhile, of course, when it comes to the labor print that we got at 8:30 this morning, here's what Acting Labor Secretary Julie Su told us last hour in response to that jobs print.
Another month of many months in which I've come here and we've talked about how we continue to see job growth, right? The numbers are still up. We're continuing to see growth in various industries. We see construction, healthcare, leisure and hospitality, right? These are all signs of an economy reaching a normal, steady, stable state.
We're going to now discuss this with PIMCO economist Tiffany Wilding. You look at the numbers this morning, there are more and more people out there that think you could see that 50 basis point rate cut in September. Are you one of them?
Yeah, I mean, so when we look at the aggregate data, we think the economy is definitely slowing, but there are indicators that would suggest historically that we've been in recession to us. When we look at a broad array of indicators, we don't think we are. So we think we're still growing, but certainly slowing. And I guess, when we think about September, we think 25 basis points is quite reasonable, given the bar that Chair Powell laid out at the Jackson Hole conference, which is that if you get further deterioration in the unemployment rate, you will see a faster pace of rate cuts. And we didn't get that. We saw the unemployment rate, tick down a little bit this month. So, I think overall, we would argue, maybe they start off with 25, but I think the bigger picture here is that the economy is returning to normal, but monetary policy is still tight. The policy rate is still elevated. And so the Fed, they need to adjust policy back to more normal levels. And the question is just how quick do they want to do that?
What are normal levels?
Yeah, I mean, I think that is one of the key questions, and I think that is why, you try to feel it out along the way. So, the Federal Reserve doesn't want to overnight just reduce rates by, 200 basis points or something closer to where they believe normal is, because they kind of want to go in increments to see how the economy responds, to get information on where normal is along the way. So certainly I think getting there a little bit faster than what they were projecting when they came out with their forecasts in June. I think they'll be a bit more aggressive with their cutting cycle when they talk about it in September. But overall, we still think that the economy here is not consistent with a recession and more aggressive cuts to lower levels.
And you think about what big pieces of data we have left until we get to that September Fed meeting. We have inflation next week, so the party isn't over yet here. And it feels like, of course, the Fed and markets, traders, investors have really shifted their attention from inflation. Now it's just the labor data that we are mono-focused on. Do you think that's the right course of action here? Do you see any risk that inflation could re-accelerate and maybe take us by surprise?
Well, I mean, certainly there's always the risk. Obviously there can be a lot or different range of things that happen. But I think the bigger point to us and why we think there's a focus on the labor market is that post-pandemic, we had labor scarcity. We had very tight labor markets. That was clearly putting upward pressure on wages. If we look at a broad range of labor market data, as I said, it's slowing and it's normalizing. It does not look like a labor market now that is putting upward pressure on wages. And if it's a labor market that's not putting upward pressure on wages, then over time you should expect inflation, to get back to at least close to target, if not at target levels. So I think that's why you've seen Chair Powell basically say that the distribution of risks around the inflation outlook is no longer to the upside. We are more balanced on that, and if anything, just because historically when you've got negative labor market momentum, it tends to feed off each other. The risks are maybe to the downside. So they have, as a result of that, I think adjusted their view. They probably are going to cut a little bit more aggressively, and I think that's appropriate just given the economy is getting back to normal.
I'm really interested, Tiffany, in the quality of the data that we are getting, because you have the market significantly reacting to various data points throughout the week. You had a 10 basis point move downward in the 2-year yield on Wednesday alone. This morning, you had a significant move on the heels of that job report, but that move has all but erased. You actually have the 2-year currently flat. You still have Fed swaps pricing in more than 110 basis points worth of rate cuts through the end of the year. But it makes me wonder, is it the jobs data that's going to be guiding the market most firmly moving forward? Or do we have to start parsing more economic data more seriously, like manufacturing data and other data points?
Yeah, I mean, I think if you look at the broader range of data on the economy, it supports this view that we're not in recession. We're slowing. If you look at consumption data, credit card spending data that's more real time, retail sales data, it basically suggests that the consumer's doing okay. We're tracking consumption growth for the third quarter to be over 2%. Overall this year, consumption growth has been about 2.5%. That again is an economy and a consumer, that's just doing fine. It's not consistent, with an economy that's in recession. So I think you have to be very careful about the various indicators. All of them are noisy. We had a very large increase in immigration over the last couple of years. That's moderated this year, but the indicators that we look at are not set up to pick up in real time those increases in immigration flows. So I think it's distorting some of the labor market indicators. It's resulted in the rise in the unemployment rate, and it's making things a little bit more difficult to read. And I think that's why you're seeing more market volatility around these various data releases, just because there's more uncertainty, the data is a bit more noisy, and you have to put all the pieces together here.
You were a Treasury market policy analyst at the New York Fed at the beginning of your career. What do you think about the debt and deficit that seems to get talked about, but no one really worries about it. Nobody has a plan to reduce it, and we're looking at, $100 billion plus in servicing costs every month.
Yeah, well, just from purely kind of from a math perspective, as the Federal Reserve starts to cut interest rates, that should, kind of help ultimately with the deficit outlook. So deficits are sustainable if you have real interest rates that are below real growth rates, right? Because real growth rates, that's all about tax revenues, and the interest costs are on the expenditure side for the government. So, that quote, R less than G is, the government is still under a sustainable debt load right now. But that doesn't change the fact that if you look at the CBO estimates for future deficits, for example, and debt, we are expected over the next 30 years to get to 200% of GDP almost. So at some point, we are going to have policymakers that have to make hard decisions. It doesn't appear that that's going to be, either candidate, current presidential candidate is certainly not running on a platform of fiscal austerity. So maybe it doesn't happen in the next 4 years, but at some point it does need to happen. Now, I think the markets are giving the U.S. federal government a lot of long-term credibility for a couple of reasons. One is just the dollar is still the reserve currency of the world. Treasury markets are exceptional because they're the safe asset of the world. But also, if you look versus other countries, other developed market countries, the U.S. actually, the reason why we have larger deficits is we raise less tax revenue. So I think there is room there. If the markets, you had bond vigilantes coming back and the government needed to do something, they could raise revenues by increasing taxes.
Great perspective. Really glad we had you on. Tiffany, thanks so much for joining us. PIMCO economist Tiffany Wilding. Let's get a look now at some of the stocks moving at this hour. For that, we go over to Abigail Doolittle. Abby, what do you got?
Well, let's take a look at the shares of Broadcom, because on the day they are down about 8% or so. This after they actually put up a really strong quarter relative to the AI segment, but it was the other pieces of the puzzle, the other pieces of their revenue pie that were a little bit less. The guide for the fourth quarter coming in short of the analyst expectations. The guide for $14 billion. Again, a little bit short in terms of the quarter that was. They beat, but price to perfection to some degree on the year. Not up nearly as much as NVIDIA into this quarter, but up, and investors wanted some form of not just perfection, they wanted the company to be able to match numbers. Let's check out this software company, ticker PATH, Path. And it's interesting, this stock had been up more than 3% earlier. They put up a good quarter. Now it's down about 0.6%. Their full year forecast, they did raise it. There's a almost 8% short interest on this stock, so maybe that could be a piece of it. Earlier, maybe the bear's getting out, now the bear's back in. On the year, this company has really struggled, down about 50%. And then finally, looking forward to next week, Apple's pretty strong, up about 0.8%, at its highs up more than 1%. And of course, we have the big iPhone reveal event, that iPhone 16 event next week. Into that event, we have the stock again, really pretty solid, Sonali.
Abigail, we thank you so very much. And coming up, we're going to switch gears. I'm into football now, and football is actually back. And that's good news for sports fans and Swifties. We're going to be talking about sports betting next with DraftKings CEO Jason Robbins. This is Bloomberg.
Earnings.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia Trade.
You're watching the close.
Welcome to Balance of Power. This is Bloomberg. The names that move markets are on Bloomberg.
Don't expect we're going back to zero, because zero was the product of huge global shocks. I think to get to there, something really bad has to happen that we're not currently expecting. So it'll be somewhere obviously in between. I think we've made a big point of saying policy is currently restrictive, so you can deduce from that it will be lower than where we are today, but I think it's very clear that we're not going back to zero.
Bloomberg. Context changes everything.
There is this real momentum from Wall Street. We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
Getting out of high interest to look at what's making headlines around the world. Right now, a panel of 3 judges is weighing oral arguments from Donald Trump's attempt to overturn the $83 million jury verdict against him in the E. Jean Carroll defamation suit. Separately, the judge in Trump's hush money case will soon decide whether or not to delay his sentencing scheduled for September 18th. So some legal wrangling for the president after such a nice lunch yesterday. Billionaire Larry Ellison will control Paramount Global after a group led by his son, David, completes its buyout of National Amusements. This is according to a filing with the FCC, which states Larry Ellison will own 77% of National Amusements through a trust and a series of corporations. And the Kansas City Chiefs took the first win of the NFL season last night, beating the Baltimore Ravens 27-20. Plenty of eyes on Patrick Mahomes and Travis Kelce, but also Taylor Swift taking the spotlight, watching from the stands in a Canadian tuxedo.
All right, let's stay on sports here. The spread of legal gambling has changed how millions of Americans root for their favorite teams, and the U.S. sports gambling industry has seen more than $220 billion wagered in the 5 years since the Supreme Court essentially legalized what was previously an underground market. Joining us now, I'm pleased to say we have DraftKings CEO Jason Robins, and I actually do want to ask you about Taylor Swift, but let me start with, of course, the NFL regular season. It's now underway. What visibility do you have on whether the betting handle on pro football will be more robust than what we saw last season?
Well, if Thursday night's any indicator, we're off to a fantastic start. We had big year-over-year growth and a ton of interest in the new player markets, especially the touchdown markets that we were putting out there. We had over 641 pre-match markets. Same thing again tonight. We traded over 1,300 live markets last night. So just more content, more fun stuff to bet on, and a lot of year-over-year growth.
How does it compare with what you're seeing from prior years? If Thursday was any indicator, how do you kind of project out? Especially now, we were kind of talking about it during the commercial break. Clearly, the NFL is hitting new markets. The Packers are playing in Sao Paulo tonight. What does that mean for you?
Well, I think it's fantastic that the NFL is expanding globally. I think it'll be great for interest in the sport. Obviously, we're very focused on the U.S., but I do think the more global interest in the sport is just something where rising tide lifts all ships. And really, I think it's just part of the overall trend we're seeing where more and more people around the world are getting interested in things internationally. You see the same thing in the U.S. where a lot of the betting is occurring on sports being played overseas. So I just think it's more and more of the world being globalized and people being, having more access to things. And NFL's great content, so you put it in front of people and they're going to enjoy it.
Couple of cheeseheads here on set.
2 out of 3. We'll
Shanali
take it.
is a Green Bay Packers fan. I love when I love, Jason, when the U.S. legalizes things that people are doing anyway, in the dark. But I wonder how concerned you are about a rise in gambling problems, people taking money out of retirement accounts, charging up credit cards. I mean, we hear more and more of these stories. It's obviously an addiction for many, many people. How does DraftKings deal with that problem?
Well, I think it's a very important topic you bring up, and one of the major reasons why it does make sense to have a legal regulated market. We have tens of millions of dollars that we're investing in responsible gaming every year. We have almost 100 employees working on it on their own. 100% of their job is responsible gaming. And so, it's something that we're really putting major investment into, and we have a number of different ways that we approach it. We have tools that we give to players where they can set limits for themselves. We have models that we build that help us understand and flag risky behavior, and we have a player protection team that is trained to have targeted conversations with people when those models, set off certain flags. So I think it's a real important part of having a legal regulated market. In an unregulated market, you're going to have no protections of those sorts for consumers, and people will just sort of be left to their own devices. And I think that, in the legal regulated market, not only are those requirements, but they actually become competitive advantages because people want to play in a place that they perceive as doing the right thing by customers and doing it in the right way.
I did see some study or report or article about people actually stopping day trading or cutting back on day trading because now they're trading more on sports. So there's some replacement behavior going on as well. But I actually want to ask you about taxes because, of course, August was a very volatile month for DraftKings shares. You had announced a planned tax surcharge in those higher tax states that would help offset the cost of revenue-based gaming taxes. You ultimately withdrew that plan, but are there other plans along those lines under consideration to help mitigate the effect of those high state gaming taxes?
Well, at the moment, we're really focused on NFL season and listening to what our customers want and how we can put out the best product and do the best job we can to make our customers feel like DraftKings is the place that they want to play. It's something at some point down the line we may revisit, but right now we kind of heard the customer feedback. It was something that did get received in a way that we felt made sense for us to pursue, and that's what we're really all about. We, I think, as a company, really emphasize culturally listening to the customer and following the customer, and so. Right now, with the start of NFL season, we're 1,000% focused on serving our customers and understanding how they're enjoying and what we can do better to give them the best experience possible.
I want to talk about strategy here as well, Jason, because you have agreed to buy Simple Bet, which looks to place wagers during a live sporting event. What does this mean for DraftKings? How significant is this for you?
Well, I'm very excited about Simple Bet. One, most importantly, we're getting a great team. I really have been so impressed by all the folks there, and the talent is always what makes these types of deals. But we're also getting great technology. They've built an incredible micro betting product and have a ton of other technology that can be useful for building out our live betting offering. So I think between the team and the tech stack they have, this is really going to put us in a position to accelerate our efforts in live betting and hopefully make it something where we're clearly ahead of the competitive field.
The interest of women for football, for example, obviously has soared because maybe in part Taylor Swift is dating Travis Kelce and then goes to games all the time.
I've heard that. And she, of course, was at the game last night, Jason. She was also in the NFL had a little preview of the season ahead. She appeared in that multiple times. So more women are watching the NFL. Are more women betting with DraftKings as a result?
Well, it's hard to say if it's a result. We are certainly seeing a rise in women betting on DraftKings, and of course, that's been a trend for a few years for us. So, I think there's some tailwind and just general momentum in that direction. I can't, really attribute it to Taylor, but I'm sure it can't hurt. Certainly, I know a lot of people who love her, including me, enjoy talking about it, and it gives me something to talk about with my wife. Maybe I can get her to start making a few bets, too. I haven't gotten my wife to make any bets yet, but I'm working on it.
Well, to that end, about more women betting, a conversation I've been having over the last 24 hours is what media rights would mean for women's sports to take off more. I'm curious about that more largely for you too, Jason. When you see Amazon, for example, entering the sphere in this massive, massive way with the NBA, with podcast rights, how does that change the way that you interact with different platforms, the type of audiences that you grab as the media landscape changes around sports?
Well, first of all, I think the more ways that, and the more companies, media companies and tech companies that are interested in getting eyeballs on sports, that's great for the ecosystem. It starts with having the content out there so people can consume it and having partners that are really motivated to create the best, experience, the best broadcast, the best stream around that content. So really excited to see that. And, for us, I think women's sports is a huge growth opportunity. WNBA has been a great story for us. Women's college basketball has been growing like crazy. I think women's sports is going to be one of the great growth stories of the online sports betting industry for the next several years and beyond. And it's not just women betting, though. It's really everybody. Men are betting on women's sports just as much as they're betting on, the men betting on women's sports are actually greater than the women betting on women's sports just because there's more male bettors. So I think what's awesome is to see it's not just women coming onto the platform betting on women's sports. It's really everybody.
Jason, we got to leave it there. We thank you for your time, of course, at the start of a hot NFL season. That is Jason Robbins, CEO of DraftKings. This is Bloomberg.
We spent some time here on the broader presidential race.
Let's focus in on European politics.
Makes you wonder how politics might play out.
The top names at Jackson Hole are on Bloomberg.
Inflation's kept coming down, so in the real rate sense, we've been tightening. I think that this reflects the reality of the economy, that we've got to keep our eye on the employment side of the mandate now. This is what the path down to 2% inflation looks like.
Nobody covers Jackson Hole like Bloomberg. Context changes everything. From the world of politics to the world of business, Joe Matthew and Keely Lines deliver news, insight, and analysis live 2 times a day every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg. It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg.
Let's get a quick check on the market. Do you want to check the markets?
I want to check the markets,
Let's check
Matt.
the markets.
Come on, it's like an hour into the U.S. trading session. Let's try to sell this. Actually, the market does our work for us because we have seen a big plunge. The S&P 500 now down 0.8%. We had been higher, no longer. The NASDAQ 100 leading your declines there, off about 1.6%. Now, maybe a haven bid in the bond market, currently down 2 basis points, Janali, on the 10-year yield.
And as you know, it was much more before, but you have every major industry group actually in the red this morning. I think that is fascinating. A sour note to end a sour week. This is the first decline in the S&P 500 in 3 weeks for a weekly decline.
Yeah, pretty amazing after we were pretty much at a record high on Friday last week. It's been a bummer of start to September. Coming up, how a mixed jobs report could impact U.S. consumers. We'll talk to Lending Club CEO Scott Sanborn next. This is Bloomberg.
thoughts on fast fashion? It's been transformative. It gives the masses access to fashion, but there's a cost to it, downside to it.
My first notice is too much waste. I think it's also how I grew up, making your own clothes and making something that's well special and well unique. It's like timeless. And now you see that everybody is looking the same, like wear sweatshirts and wear t-shirts. And for me, it's just like when they wear something that's special, they feel empowered.
Is there a need for fashion to be more mindful of the impact it's having socially, environmentally?
Definitely.
Is it happening enough?
I think it's happening. It's gradually happening. All the designers are doing, everybody is thinking about this subject at this moment, thinking how to be more sustainable, how to be more environmental friendly.
Do you think the fashion industry is doing enough, to ensure that it is sustainable? There's so many targets out there. Are they even realistic in wanting to achieve them?
I think some of them are just like they're using sustainable ideas as a marketing concept only. They're actually not really doing it. I think as a designer, it's really important to really make it happen. Every collection, I think about how to do it and how to tell the customers. I think that is our responsibility to educate our customers.
Bloomberg Surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern only on Bloomberg. Context changes everything.
All right, let's get a check on these markets. An hour into the U.S. trading day, we're going to do that with Bloomberg's Abigail Doolittle.
And we're having an interesting day here, Katie, where bad news is bad news for stocks. Take a look at the S&P 500 E-mini futures overnight ahead of that crucial jobs report. Really not doing all that much, dipping into it, then going higher after the number was lighter. For investors maybe thinking this means that the Fed is getting more of a green light to cut. But now, again, the idea of bad news is bad news. Right now, the S&P 500 down about 4%, 3 to 4% on the week, heading to the worst week since early March. Let's take a look at that week, in fact, from a cross-asset class standpoint. And here is that S&P 500 down 3.4%. You can see the VIX at a 21 handle, the 10-year yield down 20 bips. Now, you can say, yes, of course, that reflects the expectations that the Fed is likely to cut this month, whether it's 25 basis points or 50 basis points. But this is also a haven asset. So when you put together the picture that stocks are having their worst week in months and bonds are rallying, that is a risk-off picture. And it's driven largely, I would argue, by this strength that we're seeing for the haven yen. The dollar yen this week down 2.4%. That's the worst week since early August, when we had the culmination of that piece of the yen carry trade unwind. There may be more. If we take a look at this S&P 500 chart on the year, we are going to see a nice uptrend, but we are also going to see an area of congestion here. And actually, I guess we're not going to be able to take a look at that, but the S&P 500 does look like it is going to be coming in more. What we have here for the Fed, these are the expectations around the September meeting. At one point not so long ago, actually just 2 days ago, or yesterday I should say, we were closer to the expectation of 2 rate cuts, or 50 basis in cuts, and that right now we're at about 35 bips. It's interesting that, Matt, that everybody's talking about these cuts. In my real life, my own life, inflation is still very high. The idea that in this environment the Fed needs to cut, it doesn't entirely make sense to me, but the market seems to want it.
You're not alone, Abigail. I mean, just look at the affordability of homes and cars is out the window. Any trip to the grocery store will tell you that levels are just too high for most people right now. But the question is, how much will the Fed really cut? We've been hearing anecdotally bigger and bigger guesses, right? Howard Marks was out last week or earlier this week, I think, saying not less than 3%.
Right.
There's a story on the Bloomberg today that Citi traders are pricing in 3 50-point cuts in a row. And then you talked to John Paulson yesterday,
who said that he would go as low as 2.5%. His best guesstimate was around 3%. That 3% seems to be a little bit of the money mark here, but the market has been wrong before.
Right,
in
but
fact,
he could be
consistently.
He could end up being a pretty big deal advisor to the next president of the United States. To the next president.
Correct.
Unlikely if Kamala Harris wins that John Paulson will be advising her. But well, let's talk more about a rate cut with a man who really cares. Scott Sanborn joins us. He's the CEO of Lending Club. And Scott, just to set this up, you know, how important is it to your business? Because you got to make loans in high-rate environments just as much as in low-rate environments. I'm guessing, though, business is better when they're on the way down.
Yeah, that's exactly right. I mean, rates coming down will be great for consumers, and by extension, it's going to be great for our business, because what we do effectively is help people lower the cost of their debt. And so this will be an accelerant to that. You know, one of the issues that we face right now is that, you know, you were just talking about, people are aware that, you know, homes have gone up 30% and car prices have increased 25%, and they see, and when they take out a mortgage and when they take out an auto loan, they see that their rates have increased and they're studying their payments. Our biggest business is helping people refinance out of credit card debt, which has grown, you know, 25% over the last couple of years. And the interest rates, people don't see them. They don't, you know, when you take out a card, when you get your Southwest card, you don't look at, you're going for the miles. You're not looking what your interest rate is, right? Or your Bloomingdale's card. And then when you're building your debt, you don't see the implications on your monthly payments.
Dude, even even an Amex, I'm looking at my Amex and I have a decent credit, and I'm still seeing like 20 to 25% APRs, like unbelievable if you don't, you know, pay the bill every month.
Yeah, Scott, you know,
that's right. That's average. That's your average card is about 23%. New cards are 25. I have a Bloomingdale's card. I've got like a 785 FICO, and it's a 34% interest rate.
But do those change, right? Because even that 25%, I'm looking at Lending Tree data. I know that you probably have your own as well. The APRs are the highest they've seen it since they started tracking the data. Does that move down after moving so high up?
Well, typically credit cards track the prime rate, and they track it on a lag. So the Fed moves, cards typically move 2 to 3 months later. The issue is consumers don't actually know that. Half of all consumers don't know the interest rate on their cards. Sounds like some of you did the work. It's really hard to find. They're not forced or required to proactively notify you. So consumers don't know that their rates have gone up. Even the people who say they know their rate, when we ask, okay, did you know they've gone up because it's, you know, the rate environment has shifted, they don't know that either. So they will come down. They'll come down on a lag, but there are some complicating factors, which is the regulatory environment can change how credit card companies are pricing, right? And, you know, some of the recent changes around late fee rules are looking like they're going to drive APRs up. So that could actually counterbalance a shift downward in the rate environment.
I'm looking at, if I look at your stock against, you know, the banks, it's underperformed over the last 5 years. I'm guessing because they're, you know, much more diversified businesses. Can you diversify your business more?
Absolutely. So, you know, the first, you know, our entry wedge for consumers is for the half of all Americans who haven't paid off their credit card debt, you have a loan, we've got a better one for you. It takes less than 2 minutes. We're going to save you, in this environment, we're saving you like 600 basis points off of your credit card rate. Your FICO score goes up, you'll be debt-free in 3 years. Our goal is to take that very, very satisfied customer and do more for them. Over 80% of our customers say they want to do more with us. We are now a bank ourselves. We acquired a bank about 3 years ago, so we offer banking services. We also have an auto refinance business. You know, auto loans, the cost of an auto loan has gone up about 55%. So our ability to do the same thing, which is, hey, keep driving your same car, pay it off in the same time frame, we can lower your rate. So over time, we plan to acquire these customers and then help them save across other areas of their credit.
I believe your high yield savings account right now is at about 5.3% APY. How much does that go down as rates start to subside?
Yeah, now we would expect, look, we're a fully digital bank, and our whole brand mission is about turning banking on its head, right? Traditionally in banking, you selected your bank based on the location of the bank branch. You went there and you never went anywhere else. And what that resulted in is, as a loyal customer to a bank, you are factually getting paid less on your deposits and you are being charged more for your credit. We want to turn that on its head and basically say, hey, the more you do with us, the better it is for us, and we're going to make it better for you, right? We're going to give the advantage to our members. So we would anticipate to always be sort of near the top of the market and for the rates we charge, the rates we pay for our savings accounts, and be towards the bottom of the market for what we charge on credit. And we can do that because digitally native, highly automated, close to 80% of our loans are auto decisioned as an example. So our rates will move down. They'll move down on a lag, but we would anticipate continuing to be at the top of the market. And, another difference for us is we're still growing, right? We are continuing to grow our balance sheet, continuing to grow our loan volume. So we're going to need those deposits, and we're happy to pay for them.
Scott, with that growth, do you continue to keep clients in the same quality level in terms of FICO scores? And what's the fluctuation of your applicants look like right now in terms of FICO scores? Because we hear so much about a weak consumer. Is the average applicant FICO score falling?
Yeah, so no. What we've seen, so one of the things you saw coming out of COVID was credit scores got warped, right? People delevered, they paid down their debt. They couldn't spend, right? You couldn't go to restaurants, you weren't traveling, you weren't buying new clothes to go to the office because you weren't going to the office. People delevered. It sort of artificially, temporarily spiked FICO scores, and lenders who weren't in front of it really got burned, and consumers got access to credit they maybe shouldn't have. And so that's why you saw weakness in a lot of categories: auto, credit cards, and personal loans.
Scott,
yeah, go ahead.
I want to switch gears for a second here because there's another thing happening in the card industry that I think is really important here, and it's this probe by the United States on reward programs, loyalty programs being offered through the major airlines here. Reward programs are a really common practice in the card industry. I'm wondering what you think about this probe and how it might change behaviors in the lending industry.
Yeah, I mean, all of these regulatory actions have reactions somewhere in the system. What I will say is the card margins aren't going to go down. They're going to figure out a way to get it back. I mean, we saw that when Dodd-Frank was passed with a bunch of restrictions on cards. What happened? Average card APRs went up. We're seeing the same thing with the late fee rules. Where there's a kind of a direction to bring late fees down to $8. And so what's happening? Coupons are going up. So the degree to which this is the right priority for the regulators, I can't judge. But what I can tell you is they're going to figure out a way, and they being the credit card operators are going to figure out a way to make it back somehow.
They're going to get them money?
Yeah, they are.
I don't know why I did that accent.
No matter what.
Scott, thanks so much for joining us. Lending Club CEO Scott Sanborn giving it to us straight. I really appreciate that. Coming up, not everyone is cashing in on the AI gold rush. Former IBM CEO Sam Palmisano says Intel is now behind the trend. This is Bloomberg.
The top names in tech are on Bloomberg.
A large number of countries are subsidizing their regional data centers so that they could become able to build out their AI infrastructure. They recognize that their country's knowledge, their country's